Clients are in the market. They're invested. They're happy because markets are at all-time high.
The key driver of this bull market has been AI and tech.
Everyone who announces plans to spend is rewarded.
The AI investment, I think, is just starting to scratch the surface.
It's when founders and disruptors show up at the same time and they collide and they change the landscape, right? And I think that's a moment that we're in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday on a two-day losing streak, equity futures finding some stability after pulling back from record highs as Intel stock jumps after approaching Apple about securing investment, and Oracle raises $18 billion in the second biggest bond sale this year. Signs of fatigue. What fatigue?
Well, I have fatigue. Evidently, the market feels a lot less than I do right now because it seems like capital markets wide open. We're talking about bond sales at the fastest pace going back several years. If you look at just, for example, high-yield bond sales, Oracle coming out with this massive bond issuance, leverage starting to creep into some of the build-out of some of the tech equipment. The larger point here is, sure, we may see a pullback in stocks. We're still near record highs. The pullback is unusual, and capital markets very much wide open.
And not exactly testing the limits of investor tolerance right now. Just think about what's happened in the last 24 hours. Alibaba comes out and says we're going to spend more. Stock rallies. Intel, based on our reporting, just having a conversation with Apple, and that's enough to send the stock soaring.
You know, I'm confused by that because Apple didn't confirm its investment. The fact that Intel is approaching the likes of Apple raises a question about just how much or how little investment commitment they've already gotten. But the idea that investors welcome anything having to do with artificial intelligence feels frothy, maybe, but at the same time, if people are buying, others will certainly get on board.
Bernstein had a note out this morning about this potential talks, and maybe this leads to a deal, saying, why are companies so eager to throw money at Intel's way, given their track record? Oh, I'll tell you why. Intel is going around basically saying we are backed by President Trump. And if you want to maybe, have some warmer relationships with this Oval Office, it would be a good idea to look at Intel's way. What is in it for Apple besides some patriotic credibility the next time Tim Cook sees Donald Trump?
Intel up in a pre-market by another 3.6%. Let's talk about the Federal Reserve. Here's a take for you from Mike Dada of Roth, who says the Fed appears to be placing an undue amount of weight on highly volatile payrolls figures while downplaying forward-looking credit market and financial market indicators. This market is telling a different story.
Yeah, especially when you pair it with what he pointed out was 53 consecutive months of inflation above that 2% target. The market has moved on. Is the market reflecting a reality that hasn't yet shown up? Or are we already seeing that positive reality get baked into some of the numbers? Look, a lot of questions right now. Fed officials seem to be parsing through this with a varying degree of stress and difficulty. The issue for me is, are we baking into your question that you've asked many times, an acceleration that already is underway, or one that the Fed is only going to fuel early next year?
Over at the Federal Reserve, we'll be speaking to the man of the moment, Stephen Miran. Governor Miran joining us at 8:15 Eastern Time. Do not miss this conversation. He is pushing for some aggressive moves from this institution. He joins us a little bit later this morning. If you are just joining us, welcome to the program. Equity futures slightly softer on the S&P 500. Coming up over the next hour, we'll catch up with Matt Miskin of John Hancock as stocks look to snap a two-day slide. Dan Ives of Wedbush joins us as Intel turns to Apple to boost its comeback bid, and Joseph Spak of UBS on the street high upgrade to GM. We begin this hour with stocks holding steady ahead of the latest read on the US labour market. Matt Miskin of John Hancock writing the following: this year has been a short-term investor's dream market. We still like the US the best and are still calling for an overweight to technology. Matt joins us now for more. Matt, welcome to the programme. Lots to talk about. Let's start with that overweight to technology. Are we reaching the limits of investor tolerance, or can this one keep on going?
Yeah, John, it is getting more challenging as the valuations are getting tapped out. It is going to be hard for valuations to help the technology sector for a long-term investor. Short-term investors are really benefiting from the increase in day trading and more investors coming in trying to get as much as they can out of this market. In our view, multiples are tapped out across basically all global equities. So you're not going to see that as a return driver. But earnings growth is the last equity return driver left. And technology companies are growing earnings. Now, what we're hearing and what we're seeing is it's almost like a circular feedback loop. There's so much cash on these balance sheets, and they're basically paying each other for services within the technology sector. It's almost keeping the money right there. But we're following the earnings growth. We're following better balance sheets, higher ROE companies. We're trying to minimize low quality stocks within portfolios. And we still have that technology weight there because they are still the highest quality companies in the world.
Matt, let's follow that earnings growth. This came from Scott Chronert of Citi. He's going to join us later. The S&P 500 is pricing in a forward growth expectation in a manner that has only existed 2 other times in the past 30 years. Matt, just how high is the bar into next year?
14% earnings growth is the consensus. On 22, we're almost at 23 times forward PE. So we're basically on the highest multiple. And then this is a little bit of math. I know it's early, John, but the PE ratio, the denominator, the E, already embeds 13% earnings growth. So for you to get more out of this, you've got to get you can't get much more multiple expansion. You got to get earnings to beat that 13% rate. Now, here's why. Overall, for equities, we've been modestly underweight. It has been a brutal year to be modestly underweight equities. But this is the deal. This is the issue we're dealing with, is that this market is priced for perfection in a far from perfect world. There are going to be risks into next year. Next year, 2026, growth estimates on the earnings side and the economic side, frankly, are booming. And we think that next year is going to be a tougher year than the markets are pricing in. We're a little bit underweight risk. We're a bit more overweight bonds, a bit more overweight income as a return driver. It has been a tough year. I know Lisa's probably going to be coming up next, but we think that that's a more comfortable position to be, and we think that's riding out the volatility in a better way.
I'm not going to hold you accountable, Matt, for maybe not seeing the rally for the beginning part of this year, but I am wondering if someone were a bull and they were sitting here listening to everything you would say, they'd say, actually, for big tech, it is almost perfection in terms of the environment. And then if you add on top of it rate cuts heading into next year, that actually helps some of the multiples, even at these elevated valuations, which is the reason why everyone's getting increasingly exuberant. Why do you reject that?
Yeah, I mean, Lisa, you did tweet this morning about how AI is basically keeping this economy alive. If you took out AI, we may be in a recession right now. You look at all the charts, all the economic charts, and basically we are near recession levels as it relates to jobs data, as it relates to leading indicators, so on and so forth. The AI side, the spending has been so powerful, but what's the next? All right, so the companies are buying all this AI stuff, the infrastructure, everything behind it. Now they got to use it and they got to make money off of it. That has yet to be seen. So as we go into next year, all right, it's great that we can now do things a little bit quicker than before. Is that profitable? Is there a way to generate cash flow off that? And as you see this circular feedback loop as of late, where, as you commented before I jumped on, where I was, hey, you could just say you're spending on AI and the market already rewards you. Great. That's CapEx, though, that you need a return on investment. So I think that is where it gets a little frothy. I think the bull side, rate cuts, yes, but it's not as much rate cuts as you know, looking into next year. The Fed's only saying 1 more. We're getting 3 this year. We think that's fair. The tax cuts aren't as big as you might think. We're looking at basically just a continuation of already the tax cuts. So we think the sentiment has gone beyond the positive fundamentals. We're just going a bit underweight beta, like a 0.9 beta, as the froth has gotten more ingrained into this market.
You said something, Matt, that I thought was really interesting, that maybe this market is overpricing how many rate cuts is priced into the market, or is going to be, how many are going to be effectuated next year. And yet you see opportunity in long duration bonds. Can you kind of square that circle?
Yeah, so we're more in the intermediate part of the curve. We're income investors, so we're not playing a ton of duration as a return. We think we can get 4 to 5% in return just from an income side. In terms of the outlook, the Fed is saying 1 next year. To us, that's too little. We actually think there's going to be more like 3 to 4 next year. The bond market is pricing in 2, but just going into why the market is so positive, to your point, it's basically saying, hey, there's tax cuts and rate cuts. My point is actually that the tax cuts aren't as big as you think. The rate cuts being priced in aren't as much as you think. And we actually think that the bond market's going to have to adjust more. The bond market's not as expensive as everything else. It's still coming out of the biggest bear market basically in history from 2022. Everything else is at all-time highs, super high valuation. Bonds are still licking the wounds of 2022, and we think they have got more upside potential in the next year. that's why we're sitting here collecting nice income while we wait.
When you say 3 or 4 times next year for the Fed, Matt, is that because of economic conditions or because a new regime politically pushed potentially next year at the Federal Reserve?
Yeah, and Marie, this is the debate that is going on across, I think, all firms that are looking at Fed policy in the next year. And you're really trying to say, is there a Powell rate policy and then a post-Powell rate policy? And I can't wait to dial into your interview at 8:15 to hear kind of more perspective. But at the end of the day, we think actually you're going to be more able to see where the economy stands in 6 months or so. So let's go into May of next year. If the employment rate and basically the jobs market is still doing what it's doing right now and the trend is negative, you're going to know that we should be cutting. If the jobs market reaccelerates by the end of the year, then you're also going to know, all right, we probably don't need to cut as much. And also with inflation, you're going to get more answers on tariffs. We think actually the Fed is very divided right now. They may actually come together into next year because the policy is going to give you, or the economic data is going to give you more answers. In our view, the jobs data, it's very unlikely that it reaccelerates. And we actually think that it's going to be weaker than you think into next year. And as a result, the Fed's probably going to be cutting more than the markets think into 2026.
Yeah, Matt, just quickly then, with that in mind, Governor Miran coming up a little bit later. What do you want to know? He's made some massive calls in the past week. What's the question you want the answer to?
Yeah, it's just going back to the labor data and just saying, hey, what's the unemployment rate that would be the trigger to kind of cut more aggressively, maybe 50 basis point cuts or, maybe 4 to 5 cuts next year. And, just looking at also the housing data. I still struggle with the Federal Reserve not focusing on housing. It's such a big part of inflation. It's 35% of CPI, and it is decelerating. Some of the housing data this week's been all over the place, but generally speaking, we're seeing housing prices moderate to nearly negative on a year-over-year basis. And if that gets caught up into the CPI, the inflation data in the next year, they're going to be behind the curve. So I'd love to hear about employment data. What are they watching exactly? And then can you talk about housing and how that's going to feed into CPI into 2026? That might actually be a pretty compelling thesis for more cuts in the next year.
Interesting. We'll find some space for that, Matt. Always good to catch up, sir. Thank you. Matt Miskin there of John Hancock. Governor Stephen Miran coming up later on this morning, 8:15 Eastern Time. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Good morning, John. U.S. Envoy Steve Witkoff is predicting a breakthrough in the Israel-Hamas conflict in the coming days. The comments follow President Trump's meetings this week at the UN with officials from nations including Egypt, Qatar, Turkey, and Saudi Arabia. Witkoff didn't offer details, but said the plan addresses Israeli concerns as well as those of its neighbors. Meanwhile, HSBC says it has made a breakthrough in deploying quantum computing in financial markets. The bank says it is the first time real trades have been used at scale to show the potential benefits of the emerging technology. One senior executive even describing it as a Sputnik moment for the industry. And a check on Intel shares. They are rising 3.6% in the pre-market. Sources telling us here at Bloomberg that the chip maker approached Apple about securing an investment. Apple was a longtime Intel customer that switched to in-house processors in the past 5 years. The deal would follow a $5 billion investment last week by NVIDIA. That's your Bloomberg Brief. John?
Follows a 6% move just yesterday off the back of this news. Yahara, thank you. Up again this morning. Up next on the program, a looming government shutdown.
We hope there's a path forward to avoid this Trump shutdown.
The Democrats are trying to hijack it to get $1 trillion in new spending, and I don't think that's a very good deal for the American taxpayer.
Here we go again. John Lieber of Eurasia Group up next. Live from New York City this morning. Good morning. People really do prep for this program, watching old interviews, combing through Bramo's social media accounts.
Yes.
Matt Miskin wasn't bad, eh?
He did a great job. Matt, thank you for reading. One viewer, one watcher. We appreciate it.
He knew exactly what was coming. Equity futures on the S&P 500, almost totally unchanged. 2-day slide. Easy to sit here and say the anxiety's building. fatigue and all of that kind of stuff, we're still within 1% of all-time highs. Alibaba's just had a big rally off the back of just announcing more spending. And Intel, just off the back of our story, we're having a conversation with Apple. Stocks up yesterday, big, up 6%, up again this morning.
You know, it feels new. What's remarkable is that Apple actually moved away from Intel as one of their chip providers not so long ago during 2020 to bring it in-house. And now is this potentially a reversal? We have no idea. This is just the idea of talks, but it shows how high speculation is that Intel can get some sort of foothold in the American economy as a result of some of the backing from the White House.
Intel up 4% in the pre-market. Dan Ives of Wedbush joining us in about 15 minutes' time. Under surveillance this morning, a looming government shutdown.
We hope there's a path forward to avoid this Trump shutdown.
The Democrats' requests are completely unhinged and unreasonable and unserious.
We want to sit down. We want to negotiate. We're not going to get everything we want. They're not going to get everything they want.
The Democrats are trying to hijack it to get $1 trillion in new spending, and I don't think that's a very good deal for the American taxpayer.
So here's the latest this morning. The White House telling federal agencies to prepare plans for mass firings in the event of a government shutdown, with funding set to lapse on October 1st. Bloomberg's Tyler Kendall has the latest here in New York. Good morning, Tyler.
Hey, John. Good morning. The White House is essentially using the threat of permanent layoffs as leverage in these negotiations to keep the government open. And this does mark a significant escalation to what's considered to be normal protocol during a shutdown. Typically, non-essential workers are furloughed and then they're brought back with back pay once the government reopens. But now we have this new memo released by the OMB, which is directing agencies to essentially identify a list of workers that are funded through non-mandatory funds and then new funding from the One Big Beautiful Bill, as well as to identify those workers that are part of programs that might not fit with the president's broader priorities. And the OMB says that these could be the workers that are on the chopping block. We've never seen an escalation like this before. And while the OMB did decline to comment on the scope of what these layoffs could look like, we know that 6 out of 10 federal workers are typically deemed essential during shutdowns, which means that they can keep working. But we should also keep in mind here that the bulk of federal workers actually aren't in Washington. Less than 20% work in the nation's capital. So this could have some pretty broad-ranging impacts. John, we really saw the negotiations for keeping the government open derailed earlier this week. President Trump was actually supposed to meet today with Democratic leaders at the White House, but then he ultimately posted on Truth Social and said that it wouldn't be worth his time. Republicans are looking for Democrats to get on board with a short-term stopgap measure that would fund the government until November 21st. But Democrats say they want to see some key concessions, including when it comes to health care. They want to roll back some of those changes that we saw to Medicaid under the One Big Beautiful Bill. But at this point, John, it doesn't seem like Republicans would make any changes to the president's signature legislation.
Tyler Kendall with the latest. Thank you. Let's get to those requests. Joining us now is John Lieber of Eurasia Group. Just to build on what Tyler was talking about there, John, the Democrats' requests are completely unhinged, unreasonable, unserious. You heard the quote. John, what are they asking for?
Yeah, I mean, you heard Tyler break down a lot of that. They're asking for changes to the Big Beautiful Bill. They want to restore some of the funding that the Trump administration cut unilaterally from agency funding earlier this year. And there's one nugget, which actually is somewhat, both of those are non-starters, and there's a few other things like that. But there's one nugget that is a little bit more bipartisan, and that's these Obamacare subsidies, which expire at the end of the fiscal year. The Democrats want to make them permanent. The Republicans are actually open to extending those, but not for permanently. So there's several tens of billions of dollars in healthcare subsidies that could go along here that the two sides could agree to, which the Republicans are saying, give us a few more weeks and we'll work out a deal. The Democrats are saying, no, let's do this right now, which is why I think the government's on the verge of a shutdown.
Well, aren't they on the verge of a shutdown also by the fact that the speaker is telling lawmakers not to show up till October 1st, when the government would already be in shutdown? They're not even trying to take a vote?
Right. Yeah, they're not going to try to do this because the Republicans think they have the upper hand here. And I think that's why the Democrats are kind of desperate to look like this is the Republicans' fault. In the past, the blame game of these shutdowns is a big part of this thing. I think in this case, the blame game doesn't matter at all. I mean, President Trump shut down the government personally for about a month in his first term and paid no political price for it. So I don't think I don't think when this is all said and done, anyone's going to emerge from this shutdown as a winner or a loser. And I would be looking at the policy. And what the Republicans are saying is that we don't really care about the policy. And now you've got the Office of Management and the Budget saying we're going to shut down agencies permanently if you allow us to shut them down temporarily. And that seems like a big policy loss to me. So if I were the Democrats, I'd be extraordinarily worried about this shutdown coming, but it looks like they're headed there anyway.
Is that memo from the White House just more of a threat and pressure they're trying to exert on Democrats, or are they serious, not letting a good crisis go to waste and actually want to eliminate government jobs?
Yeah, I mean, it could be a threat. We don't know, but you got to take it seriously because this administration has done quite a few unprecedented things. We know that they want to eliminate agencies. We know they want to reduce headcount in the federal government, and we know they're looking for opportunities to do so legally. And this could provide an opportunity to do so. They're kind of saying, go ahead, Democrats, make my day. Let's shut down the government and we'll see what happens. And, I think that this is a bluff that I would personally be scared to call if I were the Democrats because of all the other insanely unprecedented things in different ways this administration has been pushing the federal bureaucracy. And I think it's a real concern.
John, if the government were to shut down and they do make good on this threat, which departments do you think would get eliminated?
Oh, I mean, they've already eliminated the Department of Education. So, I mean, I think that's the low-hanging fruit. I think there's probably going to be workers at the Department of Labor that are affected by this. That's one of the areas the Republicans are typically more hostile. I think it's possible you get the Environmental Protection Agency. There's a whole host of ones where I think that there's, HHS, I assume there's some bloat they want to get rid of. There's a whole host of ones that are not core to what Republicans care about. And I think it's important to note they have discretion to put the money where they do care about it, because either some of these funds have been declared mandatory, so not subject to appropriation, or because the administration can deem workers essential. So one place they're not going to be cutting is Immigration and Customs Enforcement. They're not going to be cutting the Department of Defense. They're not going to be cutting, Social Security or Medicare, because those are mandatory programs. But these are, they're basically just they'll be able to take control of the government and put the money into the law enforcement agencies that they like, ignore the ones the Democrats don't. And this could go on for a prolonged period of time.
John, you said earlier that there are no political winners or losers from this, but can you give us a sense of, from a polling perspective, how much the average American voter really cares about this? I know the market isn't paying any attention whatsoever until it goes on for more than a month. But how about the average rank and file member of the United States?
Yeah, I mean, there's just not great. I mean, I think that there's polling data from previous episodes where you can say who's to blame for the shutdown and, ask whose fault this is. But if you look out over a period of 6 or 12 months, the shutdown fades into the background. So what really matters here is how does this affect the midterm elections? We are more than 12 months out from the midterm elections. This is not going to affect the midterm elections at all. So I think that either side, the political consequences of this are going to be extremely muted. And we've seen this time and time again. You get a big shutdown in 2014, a big shutdown in 2019. It's just not what voters care about 6 and 12 months down the road, which is why I think ultimately the politics of this are completely irrelevant. And it's just an inside baseball, inside Beltway game to argue about it. But the policy impact is the thing that politicians should be looking at.
Well, Hakeem Jeffrey sat down with our colleagues at Bloomberg Government yesterday for exclusive roundtable, and he said Democrats are really going to be focusing on health care. Is that some place that Democrats could potentially make inroads ahead of the midterm election? And when it comes to this government shutdown?
It's typically been the area where Democrats poll better than Republicans. So I think this is them trying to get the upper hand coming into the midterm elections. Totally plausible to me, I guess, that could be something. But, I think a lot of this stuff is just fades into background noise, right? I mean, how many of these shutdown battles have we had over the last decade? And how many actual shutdowns have we had? And there's so much else going on in the news cycle that I think this just ends up fading away. Yeah, people's vacations will be disrupted and there will be real problems that start to bite in the real world, particularly if the shutdown goes on a long time. But I just don't think this is a great way to position yourself.
Hey, John, thank you, sir. As always, John Lieber there of Eurasia Group talked a lot about fatigue in the market. Fatigue with this story. People in this market just do not care about this story at all.
I think it doesn't even rise to the fatigue level because there are other things to get fatigued about, so people just sort of ignore.
We're going to ignore until I guess we can't no more. Coming up on the programme, Dan Ives of Wedbush as Intel turns to Apple to boost this turnaround. Two-day losing streak on the S&P 500 this morning, down by just 0.1%, still within 1% of all-time highs. Decent rally yesterday for Intel. It continues this morning. We'll catch up and get you up to speed on what's happening with that name in just a moment. Let's turn to the bond market. Yields higher for a fifth day in 6 yesterday. We're down this morning by not even a basis point across the curve. 2's back to 360. 10's back to 414. Going to keep promoting this one, but later on this morning, 8:15 Eastern Time, Governor Miran's going to join us. You know what my first question's going to be?
What is it?
I just want to know how well received he was on the committee, walking in, how different the experience was to what he expected going into it.
Yeah, and what he felt about the other members and some of their arguments, and which he found most credible. My main question for him is, what is his response function if inflation starts to tick back up? What is that type of policy? Is it to stop cutting rates, or is it to keep going and use other levers to potentially suppress long-term rates?
These are conversations we've got to have a little bit later this morning. Look out for that. That's the setup. Let's get you some single names, some morning movers. Here's Danny Berger with more. Hey, Danny.
Hey, John, let's get with that top story that you flagged. It is Intel. Shares are soaring just under 4% this morning, approaching Apple about an investment, according to our reporting. Early stages, but the two companies are apparently also looking at how to work together. Already some bearishness on that. Bernstein's analyst Stacey Rascone writing that they have a capability issue. Money doesn't solve that problem, and they continue to question why people want to, in his words, throw money at Intel given their track record. Elsewhere, Hertz, those shares also moving much higher in the pre-market this morning, up just about 4.5%. They are offering $250 million worth of senior exchangeable notes due in 2030. They say they will use that to help pay down their debt. As part of this announcement, they also mentioned that they're doing a transaction with Bill Ackman's Pershing Square that will allow them to get more long Hertz shares. So again, those moving higher. To the downside this morning, though, is Oracle, but this thing has had a massive run higher. Shares are down 2%. Redburn analysts saying that currently, what traders are pricing in is a blue sky scenario that looks unlikely to materialize. So they initiate coverage of Oracle with the sell, saying at some point this market is going to stop focusing on the headlines and start focusing on the fundamentals. John?
Danny, we'll get to that in just a moment. Danny, thank you so much. On a radar this morning, White House officials directing federal agencies to plan for mass firings during a potential shutdown. Agencies must prepare to suspend non-essential jobs if Congress misses the October 1st funding deadline. Elsewhere, new tariffs are on the table for robotics, machinery and medical device imports after the Trump administration opened formal trade investigations. The Commerce Department has 270 days to make its policy recommendations. And finally, as Danny indicated, Oracle launching an $18 billion US investment-grade bond sale as the software maker ramps up its spending to meet the needs of the artificial intelligence boom. The move marks the second largest bond sale this year, and the order book was huge.
It was massive at a time when everyone is looking to get a hold of something that is high quality. Just to give you a sense, we were talking yesterday with Vishy Tirupattur about how we aren't seeing as much issuance as the market even wants. And yesterday, we saw something like $88 billion worth of orders for this $18 billion bond sale. It was upgraded. The prices went down. The prices went up. Yields went down on some of this paper. And this goes to $180 billion of debt sales just in September so far alone, which would be the greatest monthly tally going back for investment-grade bond sales in the U.S. since February. Question is this the beginning of an issuance boom? Does this highlight how open capital markets are? And are we starting to see the tech world use leverage, not just free cash flow, to pay for some of these investments?
It's not just IG, it's junk too. You talked about it. Junk bond sales, according to the data here at Bloomberg, the teams put it together, set to reach their highest monthly total since September 2021. The market's wide open. It's taken down the supply quite nicely.
It raises this question, and I think it's a really important one. If the Fed is cutting rates, what are they looking to stimulate? Doesn't this indicate that the market's already wide open? And is the market wide open because of the promise of Fed rate cuts to come? Or is this independent of it because there is so much demand and all that cash on the sidelines that people talk about? All of those bond investments are throwing off cash as well that need to get reinvested. So you have this dynamic where if you build it, they will come. This market wants to buy, and so there will be manufactured by Wall Street.
Oracle this morning down about 2%, but that's nothing compared to the rally we've seen more recently. Let's stick with tech. Sources telling us here at Bloomberg that Intel is eyeing investment from Apple to bolster its comeback bid. The company's discussing how to work together more closely. Joining us now is Dan Ives of Wedbush. Dan, welcome to the program. Let's just start with Intel. What problems does Intel have that money solves?
Well, look, I mean, when you think about, first of all, innovation, I mean, now with NVIDIA being a backer, I mean, that's something that's important because, look, I mean, you talked about some of the issues that Intel has had. You now have the government backing. You have NVIDIA bringing them into the AI game. Look, they are the comeback kid, Intel. So, look, could Apple do a deal with them? I think anything's on the table right now because also this just also gets you in a better spot in the 202 area code relative to, I think, the view right now. You want to be in the Intel game rather than outside if you're in big tech.
Well, Dan, let's talk about why. And let's talk about the government stake in Intel. Annmarie talked about it. Do you see that? Do these companies see that as an incentive to partner with the company, knowing that it gets them in the good favor of the White House?
Oh, yeah. I mean, my name's Dan. I mean, the point is like that 100% is at play here because it gets you, I think, in good grace in terms of the 202 area code. You were clearly seeing that this is an arms race between the U.S. and China. Intel has clearly been the laggard, and obviously it's been a nightmare. But now with this backing, you get NVIDIA, you potentially get Apple, you potentially get others. I mean, it changes the story. Now, look, they have to execute, but I mean, this is almost historical. What's happening for Intel? The stage is set. Now they have to execute.
Dan, isn't it uncomfortable for you that the U.S. government is just picking the winners and the losers?
Look, I mean, it's the new rules of the road, right? And I think it's one where when you look at Intel, if they didn't have Trump administration backing, you don't get NVIDIA back. You don't ultimately get Apple, right? So it's one where this was the laggard. You could argue, especially what's happening in China, they needed to essentially, put fuel behind this in terms of when it comes to Intel. But look, I think the reality is big tech CEOs are adjusting to new rules of the game. Intel's on the positive side of that. Others will be on the negative. And I think in this fourth industrial revolution, that's how this is going to continue to play out.
Well, do you think Tim Cook is going to do it just to get a better welcome treatment in the 202 area code, as you put it?
Yeah, look, I don't think Cook's doing it solely to, for that reason. But I mean, strategically, obviously, there could be good reasons why they do it. And look, Apple right now, I mean, they went from back against the wall, as we've talked a lot in the program, to now they're on offensive mode. I think, that Google Gemini deal on the AI front's probably next. They could do an Intel deal. They could do others because, since that DOJ win for Google, that gives Apple, I think, a lot more flexibility. But if that phone rings from the 202 area code, I think Cook picks it up.
We were talking earlier, and John brought up how it was notable that Intel shares rallied just on the idea that they approached Apple to have discussions, even without any result. We saw a similar kind of response when it came to Oracle shares, not today, but yesterday and the day before, when there was a discussion around potentially investing more in OpenAI. And then there was this question of NVIDIA and how much money they've been investing in OpenAI, and that this caused both shares, or the value of OpenAI and the shares of NVIDIA, to pop. Doesn't the market reaction make you a bit queasy when we're just buying first, asking questions later?
Yeah, Lisa, I thought you nailed it what you said before in terms of just the green light essentially right now, in terms of not just in terms of Fed, but everything that's happening in big tech, right? I mean, this is now the next stage of growth. And I think for investors, they're going to bet as it plays on. They're not going to bet against it because, it's our view. Tech stocks rally hard into year end because now you're actually seeing this next stage of investment in AI. Government's backing it as well. And I think it just comes back to investors that have bet against this and been weary, they're right now in hibernation mode, underperforming, and they can't find AI in the spreadsheets.
It's important not to talk too much in generalities, because you're right that this is a sea change, and I think a lot of people do agree with you. There is a technological revolution underway. There are going to be some very big winners. It will lay the groundwork for whatever is the next phase of business and work. Oracle shares, I want to talk about those given the fact that we were speaking with Gil Luria yesterday, who said this is one company that isn't showing it, where we're not seeing that positive operating revenue that they can put into some of these investments. It's betting on things like OpenAI and putting more money into it that it could possibly see profitability in the near term. Do you see pockets of excess, even if you are a big believer in this story?
That's like saying Scotty Scheffler is not a good golfer and he's not going to crush at Bethpage, right? I mean, to me, it's when you look at what Oracle's done, I mean, they're the case study. I mean, Benioff, Adobe, I mean, they look at Oracle, that's the playbook. Because they've bet on AI, that's what investors are focused on. In terms of profitability, some of those other metrics, that's right now, I think, in the background. You're focused on what the growth looks like when it comes to AI. And Oracle, I could argue, is still being underestimated relative to where I see it over the next 1-2 years as they play, just like Microsoft, just like Google, just like Amazon, in terms of big tech. The strong will get stronger. That's what Oracle is.
So, Dan, not a perfect example, but work with me here. I think it was back in 2018. Do you remember Long Island iced tea? And they became something like Long Blockchain? I remember having conversations about that at the time. And there were people who quite rightly had a very, very real interest in what was happening with crypto and Bitcoin that made the case that you shouldn't allow that to distract you from the real things that are happening. At the same time, you shouldn't allow the real things to distract you from the crazy things that are happening elsewhere. So, Dan, do you know any signs of bubble-type behavior happening beyond the stories that you have conviction in that you are cautious about?
Oh, of course. Look, there's fraud. I mean, there's companies I talk to, they say AI 50 times, and it feels like basically that there's really no technology there, right? So that's why we spend all of our time figuring out who are the winners, who are the imposters. There will be froth like there always is, but it's my view, like this is the real spend because of the use cases exploding. And my view of where autonomous and ultimately robotics is going. But look, that's why you have to be weird. You have to figure out who are the winners, who are the imposters. And that's why we spend all of our time doing it.
But Dan, as you know, in experience, you also have to be prepared for a washout of everything at some point. And the same thing happened with crypto. And I wonder, and again, I know it's not the perfect example or parallel, but I wonder if that's a phase we have to go through too, and whether that phase isn't too far away.
Yeah, I continue to view it. It was 1995. This is much more of a 1996 moment rather than 1999 moment. And we've said, I think it's still a few years as this all plays out, these trillions being spent. And it's our view, like in that AI party, it's still about 10:15, 10:30 p.m. Party goes to 4 a.m.
Dan, I wonder what you think if you do start seeing more deals in the bond market to finance some of the build out of the infrastructure required for tech, similar to what we see from Oracle, but from others as well. If you start to see that tech issuance really skyrocket, does that make you more concerned if this is being used, this is being done on leverage rather than free operating cash?
Look, I think it's a balance, as you hit before. But look, I think it's important because right now it's like it's only the call it the tech stalwarts that are really the ones that are funded $350 billion in capex. What you're now going to see is you're going to see a lot of other tech players. They'll finance this, whether it's debt, whether it's their own cash, because they cannot be left behind. So I think there's something from a bond market perspective. It's a green light. You're going to see, I think, significant issuance out there. But you want to see these companies, they'll be supported by investors to bet on the AI revolution. You don't want to see them in that right lane going 45 miles an hour.
Dan, if I could just ask you one final question on the geopolitics of this all. We had that Alibaba announcement this week about more AI spending, but also the fact that they are using NVIDIA chips. Do you continuously see China reliant at this moment on NVIDIA, or do you see China really moving into their homegrown heroes?
Look, I mean, they could obviously Huawei and they'll have all the focus on domestic and they're doing some great things. There's one chip in the world fueling the AI revolution. It's led by Godfather of AI, Jensen, NVIDIA. And that's why, you know, Baba and others, despite what you hear from Beijing, they'll continue. Even if it's the number 3 chip that NVIDIA comes out with, it's still years ahead of what they have domestically. And that continues to be the biggest chip on the poker table for Trump. And he knows that. And that's why wherever he goes, who's to the right of him? Wearing black leather jacket, Jensen.
Dan Ives, appreciate it, sir. As always, good to touch base. Dan Ives of Wedbush there on the latest on big tech and the AI trade. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Denmark is launching a probe over potential Russian involvement in 2 drone attacks against the country this week. The Danish defense minister described the strikes as looking systematic. Authorities are set to change legislation to restrict the use of drones in Danish airspace and discuss how to involve NATO allies. Meanwhile, we are seeing shares of H&M surging more than 8% in Sweden after it reported better than expected earnings in the third quarter as its turnaround efforts take hold. The Swedish retailer ramped up advertising to help draw shoppers back, offsetting the consumer uncertainty and rising trade barriers. This is the second consecutive quarter where earnings beat expectations. And Delta Airlines is addressing reports of toxic fumes leaking into cabin air supply. According to the Wall Street Journal, Delta is replacing power units on more than 300 of its Airbus jets. The carrier is already about 90% through the process. The issue stems from earlier reports of toxic fume events leading to brain injuries and illnesses. That's your Bloomberg Brief. John?
Yahara, thank you. Never good news coming from the airline business, is it?
Toxic fume events.
Brutal.
That sounds like
Wow,
quite the happening.
I guess the good news is they're figuring that out. Up next on the programme, relief for European autos.
The market's become very, very narrow. And unfortunately, companies like autos and a lot of the older industries are not getting the capital that they need. Europe is muddling through with, frankly, very difficult regulations. The US, as ever, going completely the other way.
A conversation up next with Joseph Spak of UBS from New York City this morning. Good morning. You're watching Bloomberg TV. Equity softer this morning. We're down by close to 0.2% on the S&P. Similar move on the Nasdaq 100, just a little bit lower following 2 days of losses on the S&P. Under surveillance this morning, relief for European autos.
The market's become very, very narrow. And unfortunately, companies like autos and a lot of the older industries are not getting the capital that they need. Europe is muddling through with, frankly, very difficult regulations. The US, as ever, going completely the other way. Growth is becoming harder and harder and harder, and investors are looking for growth wherever they can find it.
So here's the latest this morning. The United States cutting tariffs on EU autos to 15% from 25%, despite some of the headwinds facing the whole of the sector. Joseph Spak of UBS is upgrading his call on GM to a street high price target of 81. We trade this morning at 59.91. And Joseph joins us now this morning. Joseph, welcome to the program. Still getting an idea of where the policy is and where it will be over the next few years. Just walk us through this upgrade, this bigger call on GM and this new price target. What's behind it, Joseph?
Sure. Thank you very much for having me this morning. Essentially, when we look at where estimates and expectations for GM have gone post the initial round of tariffs, there was a big hit to earnings expectations. So, for instance, GM has always had this GM&A target of 8 to 10% margins, again, for their North American business. When we look at how those tariffs have impacted them, we would say it's about a 300 basis point hit. And in fact, if you look at the second quarter, margins in that segment were about 6%. What's interesting to us is that as we look towards 2026 and 2027 estimates for GM, expectations are still in that 6 to 6.5% range. And we see a path back to 8 to 10%, driven by a number of levers that GM has at its disposal. And one of them is actually a little bit of tariff relief. So, for instance, even though it's not officially finalized yet, there is sort of an agreement in place with South Korea to move that tariff rate from 25 to 15%. GM does actually import a number of vehicles from South Korea. We estimate that's about $1 billion annualized. While we're not counting it and it's not in our model, we believe the odds are more likely than not that there could be potential relief on Mexico, which obviously a lot of vehicles are imported from Mexico for GM and U.S. autos broadly. And, you know, that rate is still at 25%, where you've seen the EU, as you mentioned earlier, go to 15%, Japan, Korea, also 15%. If that were to occur, that would be about another $1 billion or so. Now, the other main factor I want to sort of call out this morning is that there are the regulatory environment in the U.S. has meaningfully changed. So that has a couple of functional applications or for GM and U.S. autos at large. The first is they don't need to buy credits from Tesla or other EV makers to be compliant for GHG, carbon, or even fuel economy in some cases. In 2024, GM expensed about $1 billion of those credits. Now, in 25, we think that's a smaller amount, but that still is, I think, tailwind headed into 2026 and beyond. And the final thing I'd say again is that because of the regulatory environment in the U.S., the automakers, including GM, really had to sort of move their mix towards a certain level of vehicles, including smaller cars, including some of the loss-making EVs, and away from the large and profitable full-size pickup trucks and full-size SUVs that these companies make. So we estimate, on average, for instance, those higher profit vehicles, might have a variable profit of about $17,500. If we take everything else GM makes, and a variable profit of about $6,000 per vehicle, and we just assume a 1% shift from low margin to high margin, which is only a little bit over 30,000 units. It's not even that much. That is worth $400 million. So in 1 year, maybe 1% is reasonable. Over a number of years, we think that can continue to move higher. And we see evidence of this because GM has announced a $4 billion investment in the U.S. Some of that is reallocating capacity from Mexico to the U.S. because of trade policy, but a portion of that is for their full-size SUV. And what's interesting to us about that is all the full-size SUVs are already made in the U.S. So this is clear incremental capacity. To us, that's a signal that they think there's more demand for the product. It's demand that was probably artificially capped because of regulatory policy. And those are very profitable vehicles. So at full ramp, that could easily be, over a number of years, another $1.5 billion to $2 billion for GM.
We just have about a minute left. I'm just wondering how much your upgrade really includes moving production back to the United States, even at potentially a higher cost.
Yeah, it really doesn't contemplate a lot of that, especially for 2026. In 2027, we do anticipate that there are more vehicles built in the U.S. because of policy. And clearly, there's a wage rate differential between the U.S. and Mexico. But also, we think with new manufacturing techniques, some new automation, for instance, there's ways to sort of help offset that differential.
Joseph, thanks for making time for us. Appreciate it. Joseph Spak there of UBS, an interesting call following his call just yesterday to upgrade that price target to a street high on General Motors. USMCA is going to be the big focus for these names into next year.
Absolutely, especially since we already see Mexico coming on board what the United States is doing. For these automakers, they actually are at the moment, a lot of these parts are tariff exempt because they are in the condition right now as being USMCA compliant. The problem is, for these automakers, is they need to see where the Trump administration wants to move on the margins, this trade deal, and it's going to mean a lot for them in terms of their supply chains.
Got some news from CarMax just moments ago. Not good numbers.
No, they missed their estimates by a significant amount. The idea that it was 64 cents earnings per share results versus the estimate of $1.03. What I find notable, and I'd love to dig more into this, is that used car prices were actually lower and used car volumes, resale volumes, were substantially lower. I'm curious as to why. Is this because of an increase in the incoming new vehicles, or is this a lack of consumer demand?
Stock is down by almost 6% so far this morning. Up next on the programme, we'll catch up with Scott Chronert of Citi, Heidi Crebo-Rediker of the Council on Foreign Relations, Ozan Tarman of Deutsche Bank, Matt Hornbach of Morgan Stanley. The second hour of Bloomberg Surveillance up next.
The economy is absorbing a stagflationary shock.
A lot of the strength in the economy is being driven by things like consumer spending.
There's still a lot of uncertainty about which way the economy breaks.
We think that the yield curve is kind of in equilibrium here.
The spreads are tight, but yields are right.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Two-day slide on the S&P 500 could become day three. We're down 0.1% on the S&P, down by 0.2 on the Nasdaq 100. In the bond market, price and yield shaping up as follows. Yields higher by not even a basis point. The 2-year at 361. Going into this data point at 8:30 Eastern Time, another read on the jobs market. Jobless claims just around the corner.
Yeah, is there a sense of a reality check, a gut check, if some of the economic data starts coming in significantly softer than people previously expected? I keep wondering, what's the bigger risk right now? A reacceleration that actually does fuel some form of inflation, or a melt up that defies even some of the more optimistic outlooks? Or is it a downturn in the economic outlook? It could break either way, as we were talking about. But this is really the key question, and which data point's going to really be the kicker to make that deciding factor?
Seemingly stocks are priced for one and not the other. Stocks are priced for a pickup and a reacceleration. Based on that, you'd have to imagine the risk is that we don't see it going into 26. Are we seeing any validation of that whatsoever? Working our way into Q4, closing out Q3.
Yeah, we are. I mean, that's the bottom line, but not everywhere, right? I mean, we just saw CarMax underperform. Big question as to why and what this means about consumer demand, particularly at the lower end of the income sphere. On the other hand, some of the big tech giants that were worried about getting into bubbles, et cetera, have delivered. Their earnings have been incredible. And even as they make these big investments, they've been largely doing it with cash, and they've been delivering the earnings to show for it. If that continues, well, maybe this is something different.
Jobless claims, 830. We're looking for 233. Previous week, 231. Those are decent numbers. Based on that, that's a strong labour market. But there are people on this Federal Reserve right now very concerned. Governor Bowman, Governor Miran, who thinks that we should be moving a lot more quickly, much more aggressively.
And Governor Miran's going to make his case right here on this program. And he really thinks that, and he says his opinion's not going to change until the data changes. And right now, he thinks that we are just way too restrictive in this economy. And he's going to continue calling for 50 basis points of cuts. This is going to be challenging, though, for Fed Chair Jay Powell in his final months of running the Federal Reserve. How does he coalesce the different thinking when you have other members of the Fed coming out still saying they are concerned about the other risk, which is inflation, and the fact that the economy is still working through the one price adjustment when it comes to tariffs?
That conversation with Governor Miran about an hour away, 8:15 Eastern Time. Look out for that. Coming up this hour, we'll catch up with Scott Chronert of Citi as investors question the AI-fueled rally. Heidi Crebo-Rediker of the Council on Foreign Relations joins us as the U.S. offers Argentina an economic lifeline, and Matt Hornbach of Morgan Stanley on a divided Federal Reserve as they watch for fresh labour data. We begin this hour with stocks finding some stability following 2 days of losses. Scott Chronert of Citi assessing the present value of future growth, writing the biggest question facing US equity investors is whether the growth expectations embedded in markets can be met, if not exceeded. Scott joins us now for more. Scott, good morning.
Great being here, Jonathan.
Hey, it's good to see you in person here in New York. Thank you, sir. I wanted to share another quote of yours with our audience. Enjoyed this note. The S&P 500 pricing in a forward growth expectation in a manner that has only existed 2 other times in the past 30 years. Just how aggressive is this pricing?
Well, I think we know for some time we've been pricing in soft landing, if not Goldilocks, right? But that's where you begin to layer in the influence of tech and the AI spending, the paradigm that's underway here. And what happens is that the market is pricing in our view, an extended period of acceleration and fundamentals related to this, okay? So what does that map to historically? And we pulled out this tool we use, present value of future growth. We last used it back in the spring of 22, when we were navigating recession risk and we were trying to determine how deep the sell-off might be. And at that point in time, we say, well, look on this measure, right? The S&P 500 is paying almost nothing for future growth. All the value in the index was predicated on the present value of flat earnings, okay? So you hold that concept for a while. When you're at that point, say, wow, it's pretty good optionality to say that over time earnings are going to grow, I'm going to be bullish, right? In which we did back at that point in time. The risk reward skewed positive. Now we're flip side, right? Now we've come kind of full circle to where when we're looking at how much of the market's value is, it can be justifiable according to where future growth is right now. And right now it's approaching 50% of the value. We've seen this in 2 periods previously. One was 99, going into the 2000 bubble burst, if you will. And then the other was in 21, when we're coming out of the COVID risk-on rally, right? Which, remember, a lot of companies got caught up in, hey, this growth dynamic is going to perpetuate. It didn't, right? So the bottom line here in all of this is that this is an issue. The market clearly is pricing in a decent amount of expectation for forward growth. We get it. The AI, storyline fits that perfectly. What's so interesting about this is that this doesn't mean you have to run to the sidelines. Back in previous periods, when you've had this much of the market pricing in that future growth, the median returns for 12 months is 7%. The point being here is that as long as the fundamentals continue to come through, you don't have to wig out on the valuation. And that's where we kind of go back and forth with, gosh, is the market rich? The market's rich if you don't think the earnings are going to grow. The market's fine if you think you're going to continue to see this earnings tailwind, which I think, increasingly we're very comfortable predicating a view on.
Well, let's talk about the market and what the market is. So this is index level analysis. Can you break it down, tech, ex-tech, whether it's the same story or whether it's different?
Yeah, so that's so in our view, okay, in the work we've done previously, is that we're suggesting that roughly half of the S&P 500 is affected by AI. So let's call it AI affected. That leaves the other half. That's going to be much more traditional, okay? So we know that we're essentially trying to navigate dual markets here. One is this AI thing that we're talking about persistently right now. The other is everything else that probably ties back more to what the Fed's doing, what the economy's doing, so on and so forth, the traditional macro condition. Interestingly, both parts of the market are equally priced versus their history on things like PEG ratios and future growth and future valuations. So nothing is being given away here, right? No matter where you look in this market, you're predicating a view on something improving, either that AI influence on fundamentals for the tech and related part of the market, or on the gradual benefit we're going to get from lower rates supporting a pickup in economic activity going into 2026. So we're out there and extended. And again, it's not shaking us. It's just saying when looking at the risk reward here, the importance of companies continuing to support all this with fundamental improvement is the big storyline for us.
This bifurcation, these different markets, how much has that been the reason why this is a market that's less sensitive to economic data? It's a market that's less sensitive longer term to even some of the Fed policies, like raising rates to where they had been.
You're spot on. I'm going to get myself in trouble here a little bit because I'm going to say the Fed hasn't really mattered for the past 2 years. We had a different sheriff in town that's really been the issue here, and that's been, we're at least 2 years into this AI spending infrastructure development tailwind, right? And it's negated a lot of the historic views on how you think about the Fed condition. I mean, a year ago, we were writing a note on cycle limbo. Basically, we didn't think there was any economic cycle in a historic perspective because the business cycle itself had been influenced, to a certain degree by what you're beginning to see in terms of the CapEx that's been unfolding related to AI. So the game has changed. And so the historical, perspectives here are certainly important, but we got to be a little bit careful in terms of how closely we expect them to give us a roadmap from this point going forward.
There is a question, though, with what Fed policy, what trajectory it does take when it comes to the other 50% of the market. Right. And Deutsche Bank put out this chart that I thought was fascinating, showing that without the overlay of tech spending, the U.S. would have been in a recession earlier this year. And this coheres with what we've heard from the CEOs of United and others in terms of consumer demand. If the Fed cuts rates, and based on what you're seeing right now, do you see a reacceleration in that other 50% that could lead to some sort of leadership differential in the market?
Yeah, so we're talking about this broadening thesis, and I think it's really important here. And the way I think about it is, again, I'm not the House Fed watcher, but what I will say is that from my perspective, the Fed should not be in restrictive policy right now. You look at 2 years of sort of a non-existent industrial production growth. You look at some of the signs of stress you're seeing coming on the consumer side, and everything tells me that the Fed should be at least towards neutral, if not potentially stimulative. Now, when you look at within the market, though, how does that play out? Well, you go down the small mid-cap space. Much less of this tech influence, much more traditional economic sensitivity. Small mid-cap's been in an earnings recession for 2 years. You've had negative earnings for 23 and 24, and you're just now starting to show signs of an inflection.
Well, but doesn't that create a bubble? I mean, honestly, don't you get more leveraged, fueled build-out of AI that ends up creating the bubble that you're worried about?
Well, okay, this is where I'm going to take it down a little bit different path. So, so what I'm suggesting here is the broadening narrative is important, but in terms of how the index continues to march to new highs, well, I'm going to argue that I need this AI-influenced tech component participating, right? But the path to a higher index level is now I get other sectors that begin to contribute positively to the price action. And you look at the bifurcation of sector performance this year, it's pretty stark. We've had this mega cap growth tech leadership, got it, very clear on what's driving all of that. Yet other parts of the market that are still trying to find footing here.
The Fed chair said this week that stocks are fairly highly valued. when Alan Greenspan talked about exuberance in the market, then the market went on a 4-year bull run. Is that where you think we are? 4 more years of this?
You know, we talk about, you know, there's as much melt-up risk as there is meltdown risk, right? And so we have to go down that path. Exuberance is a tough word. It's a tough word. What I would just say is that the expectations for performance fundamentally to follow through here are big and growing. Now, you know, there's other elements of this. You know, we talk about the productivity enhancement that potentially comes from AI, and this is a big story. As it turns out, you know, at an index level, your sort of EBITDA margins have been improving pretty persistently over the past decade. You already have sort of an improving quality dynamic that's at work as a function of the read-through of the increased capitalization of these mega cap growers. Okay. But, you know, I can also look at the S&P 500. I like to show a chart that looks at the employment for the S&P 500 over the past year. It's flat. So Q2 25 over Q2 24, no net gain in jobs within the S&P 500. Sales per employee, though, looks like this. It's up and to the right. So as you talk about the market's expensive, it's euphoric. At the same time, there's something happening here where you're getting more productivity out of your workforce, and this is where you come back to the AI opportunity for my perch. If it puts us in a position where corporate America, I'm thinking mainly large cap equities at this point, are more persistently profitable, then you know what I do? I assign a higher terminal value to that company. I'm able to justify a higher through-cycle valuation for the companies in the index.
Scott, this was super smart. I just wanted to finish on one thing. You lived 99. And the late 90s. And I get that every bubble is different. But are there things that you experienced then that you're seeing now? Is there a lesson then that you would apply to this period?
Yeah, I mean, there's a couple of lessons, right? And I think we have to expect that as you go down this path, there's going to be a lot of tag-on companies that do find their way to markets with the next novel element of this. A number of things were going on back in the tech bubble. I think in general, you know, we overcapitalized the internet infrastructure build out, but at the time, what you were doing, a lot of the times, you know, these companies weren't projected to have positive cash flow for several years. And so your price targets were, again, a function of where you thought terminal value 10 years down the road was going to be. Not a really good place for if things begin to unwind fundamentally, right? I do think that the nature of the companies involved in the spending right now, where it is coming out of free cash generation, is incredible, right? And it's very powerful. And these companies are able to do this without compromising other balance sheet machinations. For example, last I checked, 5 of the 7 Mag 7 are still net reducing fully diluted share count, right? Which is a pretty impressive place to be. So I think we're in pretty good shape in terms of the foundation of the companies making the investments. Now we have to allow the big potentially get bigger here. As a function of that free cash generation, what are you able to do? Moat build. Right? So it should not be surprising to see a lot of the acquisitions, the partnerships, all the things that happen. Well, you can do that when you have a lot of financial flexibility. Tech bubble, a little bit less. You did have the companies doing business with each other. Source of the revenues, though, was more IPO and fundraising than it was traditional free cash, a different setup.
This was a super sophisticated conversation, so forgive me for asking the following question. Can we put a price target on this? What's the price target for next year?
Well, we're base case 6,900 for mid 26, right? We haven't done our full year 26 numbers. We'll do that a little bit later. Like to get the 3Q earnings behind, but you know that's why we've been going down this base bull and bear case. And I don't want to say it's a cop out. It's recognizing that there is this different driver in place right now, and you know, we all kind of get caught up on being wary of not wanting to build too aggressive of a valuation into our expectations.
Scott,
right?
Super smart. It's good to see you in person too. Thanks for dropping by. Thank you, sir. Scott Chronert there of Citi. Let's get you an update on stories worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Turkish President Recep Tayyip Erdogan will make his first visit in 6 years to the White House today. Sources telling us here at Bloomberg the meeting is expected to clear the path for Turkey to buy U.S.-made products like Lockheed Martin fighter jets, Boeing planes, and liquefied natural gas worth more than $50 billion. Meanwhile, copper is extending gains after an accident in the world's second biggest mine. Freeport-McMoRan saying it might not be able to meet its supply contracts at its Grasberg mine in Indonesia after a mud rush incident. This as the global copper market already faces supply disruptions and soaring demand due to AI. And we are seeing shares of CarMax fall 8.4% in the pre-market after reporting second quarter earnings that came in well below analyst estimates. The used car retailer reported earnings per share of 64 cents, well below the Bloomberg consensus estimate of $1.03. Net sales and revenue also coming in light, falling 6% year over year, primarily driven by a 7.2% drop in used car sales. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, supporting Milei's Argentina.
It's very hard to believe that it is different this time, but I believe with President Milei, it is. We are not going to let a disequilibrium in the market cause a backup in his substantial economic reform.
That conversation up next with Heidi, Crebo-Rediker of the Council on Foreign Relations. Live from New York City this morning. Good morning. Welcome back to the program. Equity futures on the S&P 500 negative here by 0.3. We're down about 0.4 on the Nasdaq. Near session lows now across the board on the Russell. Small caps down by 0.39. And the surveillance this morning looking elsewhere, supporting Milei's Argentina.
People are concerned. People are skittish. It's very hard to believe that it is different this time, but I believe with President Milei, it is. We are not going to let a disequilibrium in the market cause a backup in his substantial economic reforms. I don't think the market has lost confidence in him.
So here's the latest this morning. The Treasury Secretary Scott Bessent reaffirming America's commitment to supporting Argentine President Javier Milei, praising his tireless efforts to make Argentina great again at a gala in New York. Bloomberg's Tyler Kendall joins us now for the latest. Hey, Tyler.
Hey, John. Good morning. Well, this potential $20 billion lifeline is seen as much-needed financial support for Milei as he seeks to regain investor confidence and stem a run on his nation's currency amid concerns with his own economic agenda ahead of some key midterm elections there next month. Now, the Treasury Secretary Scott Bessent does say that the terms of this deal are still being negotiated, but the fact that this deal is being made at all is effectively seen as the U.S. propping up a key ally of President Trump on the world stage in a region where China has made significant inroads, including in neighboring Brazil, which we know isn't on the best terms with this administration as it faces that 50% tariff, though President Trump does say that he has plans to meet with the Brazilian President Lula next week. I'll also quickly point out that this really does mark a shift for the administration, considering that President Trump campaigned pretty heavily against financial interventions abroad, but Argentina does appear to be that one rare case. John, you mentioned it at the top there, but the Treasury Secretary Scott Bessent did tout Milei yesterday during this gala here in New York City, saying that he's laying the groundwork for a golden age in Argentina. That, of course, echoes what President Trump told the United Nations General Assembly earlier this week, but in terms of the U.S. being in a golden age.
Tyler, thank you. Tyler Kendall with the latest. Joining us now to extend the conversation, Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, welcome back to the program. Just want to build on some of the thoughts of Scott Bessent, the Treasury Secretary, who talked about supporting the economic reforms of Argentina. Can we talk about the regional politics? Why are the reforms of Argentina so important to this White House?
So I think that Milei has really made some tremendous progress with an economy that has been a chronic defaulter and had suffered with huge problems over many decades. So he's brought inflation down beyond where anybody really could have expected and stabilized the currency. So I think everybody was really hoping that the reforms would actually take. But Milei lost support in a regional election recently. And there's an upcoming election on the 26th of October, where if Milei loses support in this nationwide midterm, then he'll have a very difficult time pushing his reforms forward. And the markets know that. And so he's faced a lot of instability in the past several days. Last week, they ran through about $1 billion plus of their reserves just defending the currency. And so I think really the ambition is for this White House to step in between now and October 26th, give the markets short-term stability in a whatever it takes moment, and put, I think the devil is really in the details with the use of the Exchange Stabilization Fund, because that's actually tricky. It's tricky in any circumstance, but Argentina is a very unique circumstance.
Well, also, I sat down with the Treasury Secretary in Argentina in April when he was there to meet Milei, and this wasn't on the table then. And when the Treasury Secretary talks about it being negotiated, the Treasury can't give a swap line. Only the Federal Reserve could. And if it is going to be a loan, then Argentina's Congress needs to vote on it. So what exactly is the U.S. willing to do?
So, I mean, that's the big question. And as you rightly point out, the Fed gives swap lines. The Treasury does not, and it does not use the Exchange Stabilization Fund for that purpose. There are conversations, if you do use that 20 billion-ish of liquid assets that are within the ESF, then, you know, the U.S. government has a process to basically price the risk of the use of those funds. And that's a conversation, this is a little in the weeds, but that's a conversation with OMB. How do you price this risk? And are we going to put this on the table for Argentina? And how are we actually going to do that? Are we going to make the same bet? I mean, this echoes, you know, what Trump 1 did in supporting a massive IMF program for Argentina back in 2018. And the IMF lent $50 billion to Argentina and took a big political risk and sort of lost that risk. And so the question is, if we do this, how do we structure it to protect taxpayers? How do we do it in a way that is useful for Argentina without putting taxpayer funds on the line that it might lose? And, you know, and really at the end of the day, how can we do this? The swap line, I think, is just terminology to make it simple for the headline. But this is actually a very complicated financial engineering exercise that's going on.
Well, China has a swap line with Argentina. Is this also the U.S. maybe countering China in South America?
Absolutely. I mean, that's part of it. Not only is this a relationship that I think is real and substantial between the Trump administration and Milei, but China has an 18 billion RMB swap line, and it could be this could be wound down. I don't think that China. I think that the U.S. would really like to see itself be the dominant player in providing any kind of support that Argentina needs. Argentina also is very resource rich, and I think this would be a strategic play as well for the U.S. in a very strategic part of the world, Latin America, where it was pointed out we don't have a lot of great relationships.
It's true. It's a good point. Heidi, thank you. Appreciate it, as always. Bramo, you know that region well, and you've seen that influence of China down in South America.
It was shocking to see how much they have really made inroads in places like Peru, in places like Chile, in Brazil for sure, as they try to lock down some of those key minerals. And the question is, what is the U.S. going to do to compete?
Coming up on the programme, we'll catch up with Ozan Tarman of Deutsche Bank, shrugging off concerns of an AI bubble. Plus, Danny has your morning movers. CarMax falling short of street expectations. That stock is down by almost 11%. Two-day losing streak on the S&P 500, about to become day 3 if we don't do something about this. We're down by about 0.3 on the S&P 500, negative by 0.4 on the NASDAQ. If you switch up the board and get to the bond market, 2-year, 10-year and 30-year bond yields. 2-year yields this morning higher by a single basis point, 361.44, up a single basis point on 10s to 416.20. In about an hour from now, another read on the labour market. Jobless claims at 8:30 Eastern Time. That is just after an important conversation we're having with a key member of the FOMC, Governor Miran, joining this programme in about 45 minutes' time. Look out for that in the next hour. With 2 hours to go until the opening bell, let's get you some morning movers, some single names. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. It continues to be the top mover this morning, and it is Intel getting all the attention, up 1.8%. Not as big of a boost as it was just an hour ago, but even so, trading this higher on a report from us that they are in talks with Apple about getting some funding from them. They're also, this is early stages, I should say, still trading off of it nonetheless. The two are also talking together and how they can work more closely together. So Intel shares rising off the back of that. Also in the last hour, we got earnings from CarMax, and they were tough. Both prices and sales of used vehicles fell and missed estimates. In fact, used car sales fell by about 7%. The CEO called it a challenging quarter, but it's been a challenging year for CarMax. Shares are down 30% year to date. You add some weight to that, down nearly 12% in the pre-market. Finally, this is a story that's been getting a lot of attention, and that is HSBC saying that they have achieved a breakthrough in using quantum computing in financial markets. They did it with an IBM processor, so it looks like IBM rising off the back of that, up 3.2%, but it allowed them to better predict the price of bonds by more than 30%. It's a key technology for the likes of IBM, and this is a very clear and real-world use case for it. John?
Very cool. I imagine we'll see much more of that still to come. Danny, thanks for that. On our radar this morning, one of our top stories, the White House telling federal agencies to prepare for mass firings as the threat of a government shutdown looms. President Trump cancelling a meeting with Democrats, calling their demands unrealistic. Elsewhere, U.S. Treasury Secretary Scott Bessent praising Argentina President Javier Milei for his tireless efforts to make his country great again. The comments coming as the U.S. moves to save the nation from financial crisis. And finally, the San Francisco Fed President Mary Daly suggesting further rate cuts are likely needed to support the labor market. But the Chicago Fed President Austin Goolsbee warning against a series of cuts, seeing the jobs market as, quote, mostly steady and solid. Some division between those two.
Yeah, although finding the division is like combing through sand to try to find hairs, because Mayor Daley also said that she doesn't see a weak labor market. She just doesn't want to see it weaken further. The reason why people are so confused is because you have the likes of the big tech companies coming out reporting high earnings. You have the likes of airlines coming out, executives saying that there's a reacceleration in purchases. And then you have CarMax, used car prices going down, people buying fewer cars. You have the likes of Starbucks coming out this morning, having a restructuring plan as a result of sluggish labor growth and this lack of consumer demand. There are confusing stories, and Fed officials are struggling with them.
Which is why they're so divided. They are divided over just where neutral is, how restrictive we actually are, how restrictive we should be. And to have that conversation openly, you need to agree on an end point, a start point. None of them agree on where neutral is, and I understand that, but ultimately that's the source of a lot of the debate, a lot of the division on the FOMC and the dot plot.
Yeah, and I don't have a lot of confidence in what exactly the reaction function is to either a weaker jobs print or potentially even a reacceleration in inflation. One thing that Mary Daly said is that recession risk is very low, talked about how she doesn't want to see a worsening in the labor market, but then Austin Goolsbee talking about inflation still remaining above target for so many years. At what point does that become a preeminent concern?
That Fed conversation continues in about 40 minutes' time. Look out for that conversation once again with Governor Miran. Let's turn to tech. Following weeks of massive investment announcements, there are growing rumblings of an AI bubble. Ozan Tarman of Deutsche Bank shrugging off concerns, saying those crying the loudest are the ones who miss the trade. Ozan joins us now for more. Ozan, good morning and welcome to New York.
Wonderful to be here.
It's always a bubble when you're not in it. Is that the takeaway on this one?
Definitely. There is a little bit of bitterness, defensiveness. But that being said, maybe for this show, right the night before, I held this big macro dinner, almost 30 clients, friends, sovereign wealth funds, hedge funds, real money. At the question round session, questioning the bubble, questioning that closed circle, AI to NVIDIA, to Oracle, questioning where we are in the labor cycle. But then trade idea session, gold S&P, long EM. So even for me, as somebody, we exchange messages. You guys know it's like being in the family. I do believe in the risk parity. It's been a great call since the April 9 fear. But to music to Lisa's ears a bit, this is a bit too much. I sense a bit of a fly in the soup. Even today, they talked up. How do we start? Again, red. Nothing major, but red. These memes flying around on gold, on AI. Don't get me wrong. I think when I come back, either from London or here in December, I think we'll still be talking positively about gold, about AI, about NASDAQ. But fear of missing out is turning into a bit of orange sign.
Can we just build on this a little bit, the relationship between risk and gold? Mm-hmm. What the traditional relationship typically is and why it's developed into something else. Why is this the long call on both gold and the NASDAQ? What's the relationship between the two now?
Very good question. It's working on risk on and risk off, John. So obviously, orthodoxy at this moment, it should work because finally, they're not exactly going Stephen Miran's way, but they are cutting. So that's going to help gold. But before that, because of everything going on in geopolitics, Russia, Ukraine, central banks feeling much better when they hold their reserves in gold, it got a big trigger. Besides that, as you know, FX at the end of the day is storytelling. You need a dollar, but you need the other side of the story as well. Even though I'm Deutsche Bank, I share some of your anxiety on what's going on in Europe, on engine of Germany. We can go into our dear island UK, Japan, China laggards. So where do you go? You don't like the dollar for very understandable reasons. Soft dollar is working, but you need somebody, some horse that keeps running, and that's gold.
Well, this sort of goes to the question of what could possibly disrupt these trades. And right now, the feeling is that the only thing that could really disrupt some of the long tech trade would be earnings that didn't come in more positively. Do you see it the other way, that you think that actually more negativity in the economic growth picture has the bigger potential to be that disruptive factor to cause the 3% decline?
I do actually, because November 19, even if Nvidia so-called misses, we can find another good story in another earnings. But all of us, you know how these markets are narrative, markets are storytelling. 3 more days like this, Jonathan will open the show a little bit differently. So
please tell us how he's going to open the show.
No, he's going to talk about these orange signs more and more. Also, one thing that I want to keep in the radar, because macro, we need to talk about rates as well. Supreme Court. These tariffs, talking about narratives, all the way from January to April, tariffs was the bad guy. Oh, he's going to do this, that, lightizer, 1930s, and because of that, TY was going to go to 5%, Euro was going to 0.95. All of a sudden now, tariffs are the good guys. Maybe he was right on certain things. Revenue, big revenue generation. On Twitter, my dear friend Torsten's talking about it. My research is talking about it. So if Supreme Court blocks this, that's off the left field. I know Annmarie will say maybe 301, they have their plan Bs, etc. But that's going to take 4 to 5 months, and that can finally move the long end.
I love how we don't even have to ask the question, so Ozan already knows what we're going to say.
I'm
exactly, which I love. It's fantastic.
I listen to you guys. This is Champions League.
Okay, fantastic. I will just say, though, that this is one reason why people keep buying big tech. And even though they're worried about valuations, that's the one area of growth that's kind of powered really the U.S. economy out of potentially what could have been a recession otherwise. Isn't that the only clean trade right now, given all the hair on the narratives that you're talking about?
Agreed. With gold aside, gold as well works on risk off. That's why even, look, I'm a macro guy. Even if we have when I poll people and they all go for higher, the lower end of that was 3%. If we get for this or that reason 3% correction on S&P, my Binky will probably come out on this show and say, buy the dip. As important as Binky, retail, who want this way or another, beat the professionals since April 9, that big panic day, on buying those dips, will continue to believe. So that, even my scenario of Supreme Court stopping the tariffs, etc., we need something else. We need more deep-seek moments. We need to question all this close circle between OpenAIs and Oracles and Nvidia. I'm not sure we're there. Maybe 2-3% correction, but doomsday, I don't see.
But the Supreme Court stopping the tariffs, won't that be bullish for equities?
I hear you. At the end of the day, they will say, look, then they'll have to do even more fiscal loosening. Equities may find a way to see that as glass half full as well. That risk would be the bigger trigger for the long end. We came into end of summer, waiting for these famous trust moments everywhere. UK, France, Japan, of course US, big beautiful bill. It happened for 4 hours on September 2, led by my island. And then look what the long ends are doing now. So steepener crowd, do you hear them now? Much more quiet on these studios, on the macro dinner roundtables. Maybe they're waiting for something new, and that can be their catalyst, at least in US.
When you have these dinners and you're talking to investors, as you say, real money, are they concerned about what we're seeing out of the U.S. government and taking stakes, and then basically companies maybe wanting to have a better reputation with this administration, considering even investing in those companies the U.S. government cares about?
Very good question. I completely hear you. Intel, Apple, right? They do. So because of that, maybe we have a world in which Nvidias keep rising, but dollar also keeps eroding a little bit. So in that sense, it's not exactly a Thatcher-Reagan world, is it? So for many different reasons, this institutional decay, different approach to US, seeing more, how do I put it, Hungary, Turkey, Argentina-like developments in Treasury, Central Bank working together in our USA as well, that makes people hedge more. the important hedge ratios. My partner in success, George Seravalos, I think a very important piece. Everybody was questioning, okay, Ozan, you guys are saying sell the dollar, but if Nvidia, Microsoft, Meta keeps going higher, that has to help the King Kong dollar. Well, no. If they are hedging, hedging when they buy their Nvidia, maybe we can have this equilibrium in which dollar remains soft and Nvidia continues to go higher.
Ozan, just a final question. What's the difference between appetite to take risks right now, comparing the investors you've dined with this week in New York to what you experienced on a weekly basis in London?
Beautiful question. Much more US-centered. Doesn't care that much about France worries, Germany, when that stimulus coming, etc. I would say still almost sucked into the equity and credit trade. Look at Oracle yesterday, 3 basis points. 3 basis point concession, that's it. So whether they like it or not, they almost get sucked into whether I give the orange signs or no, into equity and credit. Much more quiet money on the rates and FX. Unfortunately, I'm a macro guy. I need to talk up volatility, but the trade at the moment is volatility is on its knees, and we need some supplies. Otherwise, FX and rates traders continue to sell those straddles.
Dare I say things are quiet compared to the rest of this year so far, at least. Ozan, it's good to see you.
I love being here.
We'll catch up again soon, no doubt. Ozan Tarman there of Deutsche Bank. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. The FBI says the deadly shooting at a Dallas ICE facility was targeted. 1 detainee was killed and 2 others were critically injured. The shooter died of a self-inflicted gun wound and no law enforcement officers were hurt. It's the second attack at a Dallas area facility of ICE in recent months as the Trump administration ramps up mass deportations. Meanwhile, Starbucks announcing that it plans to close a number of stores and eliminate 900 jobs. Starbucks announced that the closures will focus on stores that have underperformed, with the company poised to focus on making its open locations more inviting to visit. The move comes amid a $1 billion restructuring effort undertaken by CEO Brian Niccol. Shares are slightly in the red. And in sports, New York Yankees superstar Aaron Judge made history by becoming just the 4th player in history to reach the 50 home run mark in 4 separate seasons. Judge hit both his 50th and 51st of the season against the White Sox. Judge is second in the American League this season behind Mariners catcher Cal Raleigh, who became the first ever catcher to hit 60 in a season. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. You just have to look to the one side.
I'm so excited for him.
With the merch and
Mark
everything.
McGuire, Babe Ruth, Sammy Sosa. It's an incredible list.
Okay, good stuff. All right.
Cheers
to you. Yeah. Up next on the programme, a divided Federal Reserve.
Now, my own view is that further policy adjustments are likely. Will they come right now, this year, or going forward? It's hard to say.
Matt Hornbach of Morgan Stanley joins us in just a moment, live from New York City. You're watching Bloomberg TV. Live from New York, welcome to the programme. Under surveillance this morning, a divided Federal Reserve.
Now, my own view is that further policy adjustments are likely. Will they come right now, this year, or going forward? It's hard to say. But what's really important is that making those policy adjustments will likely be required to balance both of our goals. Keep pressure on inflation to bring it to price stability and offer support to the labor market to ensure that it stays near full employment.
So here's the latest this morning. Fed officials offering more insight into the division at the FOMC. San Francisco Fed President Mary Daly saying additional rate cuts are likely needed. The Chicago Fed President Austin Goolsbee telling the Financial Times he's not comfortable front-loading cuts on transitory inflation arguments. Matt Hornbach of Morgan Stanley joins us now for more. Matt, good morning, sir.
Good morning. It's great to be here.
It's good to see you. You put in your note, and I think this is important, within the dot plot, embedded in that, is an important debate about where neutral is. Can you build on some of that?
Absolutely. I mean, when you look at the dot plot, it's very clear that in 2025, there are 2 camps. And this division has been pretty clear in all of the dot plots so far this year. What becomes a little bit more murky is when you go beyond the 2025 dots, what what happens to these camps. And I think you can divide these two camps into a camp that believes that neutral rates are higher and a camp that believes that neutral rates are lower. And it's interesting, they both agree that policy should be moving back towards neutral, and they almost agree on the time frame over which policy should move back to neutral. They just seem to disagree on where neutral is. So I think what's interesting is the speech by Governor Miran this week was talking about this concept of R-star being lower. I wrote about this last Friday. I did not know that Governor Miran was going to give a speech on R-star, but I wrote about this last Friday, which is maybe why I'm on the show today. But what I was talking about is a concept that was actually offered up by our chief U.S. economist, Michael Gapin, who is talking about the changes in labor force growth and how those changes in labor force growth over the past couple of years have probably been a very important driver of potential growth. And then there's this natural link between potential growth of the economy and equilibrium interest rates. So one of the more interesting things that has come out of John Williams and his group previously at the San Francisco Fed and now at the New York Fed is a model that tries to estimate where these things are. Where is potential growth for the economy and where is the equilibrium interest rate? Prior to the great financial crisis, both of these model estimates were the same thing. They moved in the same direction at the same time. And so if you believe, as many people do today, that we are beyond the secular stagnation period for the U.S. economy, then you must believe that as potential growth slows, R-star or equilibrium interest rates also go down. And that's kind of the point that I was making in my note.
So Governor Miran is in the mid-twos. Where are you and the team?
So Michael Gapin and team believe that R-star is likely falling. They're not at the 3% that the median FOMC participant currently finds themselves. Not speaking for Mike, but I would guess that he's going to be somewhere in the mid-twos on R-star. So not dramatically lower, probably not as low as Governor Miran is, but that's where I think he's probably going to be.
If that's true, why haven't rates where they are torpedoed the economy?
Why haven't rates torpedoed the economy? Well, okay, let's talk about how we measure change in the economy. Typically, people look at this in year-over-year terms. So let's talk about inflation. Inflation at 2.8, 2.9, 3% core PCE on a year-over-year basis. That's where inflation has been over the past year. But what about the next year? Right, we think inflation is going to continue to move lower once we get past this little bump related to tariffs. Same thing for growth, Letha. I mean, we have real growth in the economy in the mid-twos, but next year we think it will be in the mid-ones. So policy is restrictive on our estimation. And as the Fed gradually lowers interest rates on our forecast, they're really just going to be keeping up with the decline in R-star. We don't see them taking policy into accommodative territory.
So if that's the case, you potentially think that there is a greater risk of recession or economic downturn than the market is accounting for based on where rates have been, given how long they would have been quite restrictive. Is that correct?
Absolutely. I mean, the recessions in the U.S. don't occur that often, clearly. And we haven't had a normal recession since before the great financial crisis. I mean, you could even argue that in 2001, that wasn't really a normal recession. But the risks are rising because the labor market and potential growth have slowed so dramatically over the past 6 months.
If this is true, then wouldn't it be not a once in a lifetime, but a very good opportunity to buy the long end of the yield curve if you do believe that neutral is so substantially below where people currently believe?
Absolutely. At a 2.5% 30-year real yield, there's a tremendous amount of value. And it's been there for some time. So it's not as if this is a new development. 30-year real yields have been in the mid-twos. Sometimes they're high twos, sometimes they're mid-twos. But they've been generally in that zone for quite some time. That's fantastic value. Investors, long-term investors who have been buying 30-year tips are probably sitting very, very well today.
When you look at what Governor Miran is saying about the policies that the Trump administration has, which basically means that there should be lower interest rates, are they also basically then acknowledging that those policies might mean slower growth?
Well, I think there's a difference between, what's happening with the potential growth rate of the economy and then how the economy is actually growing from one year to the next. In some sense, that's how I would interpret it, that if potential growth is coming down, equilibrium interest rates should also come down. So kind of how are you wanting to frame the argument? If the argument is, hey, we think that these policies are bad for growth and therefore the economy needs lower interest rates, that's one framing, clearly. Another framing is the potential of the economy is just slowing, and it's not recessionary potential, but if the potential growth rate of the economy is slowing, then the economy simply requires lower interest rates. It's not let's sound the emergency alarm. Let's just adjust interest rate policy to accommodate an economy that is growing a little bit slower on a potential basis.
Got about 45 seconds left. Just wanted to squeeze in the FX call. What does this all mean for the US dollar?
Absolutely. We think the dollar is going lower, John. We've thought the dollar was going lower earlier this year. We continue to believe the dollar is going lower. In general, we see it as a broader trade than just euro-dollar. We think the dollar is going down against the euro, against the yen, against the Australian dollar. We see it as more of a broad-based move, and it's ultimately because we think that real yields in the U.S. are going to continue to decline.
And against gold as well, based on a conversation we had a little bit earlier.
Yeah, I just keep thinking about what this means for the two economies that we were talking about with Scott Chronert, the idea that the economy is not the tech bubble that could be still continuing to emerge and could get fueled. It's a fascinating moment right now.
Yeah, and for the market versus the economy too,
Exactly.
which seem to be on two different planets at the moment. Matt, it's good to see you. Thank you, sir. Matt Hornbach there of Morgan Stanley. Coming up next, Brent Schutte of Northwestern Mutual Life Insurance, Fed Governor Stephen Miran, Lieber Richardson of ADP, Chris Hyzy of Bank of America. The third hour of Bloomberg Surveillance just around the corner.
Clients are in the market, they're invested, they're happy because markets are at all-time high.
The key driver of this bull market has been AI and tech.
Everyone who announces plans to spend is rewarded.
The AI investment, I think, is just starting to scratch the surface.
It's when founders and disruptors show up at the same time and they collide and they change the landscape, right? And I think that's a moment that we're in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, 90 minutes away from the cash open. The opening bow just around the corner. The scores look like this. Equity futures on the S&P 500 lower by 0.4%. Session lows on the Nasdaq down by 0.6%. Likewise on the Russell, down by 0.75%. In the bond market, 2-year, 10-year, 30-year bond yields just a little bit higher by a single basis point, 29 minutes away from this data right here. Jobless claims up next.
Yeah, a question of just how powerful or not the engine of the U.S. labor market actually is. If we get a down week in terms of the S&P performance, that would be the first down week going back to August, even at a time when we're talking about some sort of deterioration in the labor market picture. Right now, the key question is, it keeps being, are people underweighting the risk of a downturn in growth, or are they underweighting the risk of potentially a reacceleration that could potentially fuel the rally even further?
We'll speak to the man of the hour a little bit later this hour. We'll catch up with Governor Miran of the FOMC, and he's got his own thoughts on the biggest risk going into 26. He believes that if you keep rates where they are right now, you're risking some real downside risk.
And he really wants the Fed to recalibrate where we are right now in economy, especially with the policies from the Trump administration. Lower immigration, less government, borrowing, lower regulation. He thinks it is way too restrictive right now. The issue is, can he bring the Fed officials along with him? Because right now there are a number, like Austin Goolsbee, who are still concerned about what tariffs may do to higher prices and inflation.
Yeah, there's two different questions, Annmarie. One is how persuasive that argument is on the committee right now. The other is how credible it is with the market participants, investors, and markets more broadly.
Right now, it has been fairly credible, the idea of rate cuts. It hasn't led to a complete unmooring of the long end of the yield curve. has encouraged people to buy gold, but that's another story. But there is this feeling that this is a difficult economy to understand and get your arms around. On one hand, people are feeling not great. They are worried about getting jobs. They experience the inflation in real time. The dual mandate of the Fed very much in conflict, but people have talked about the idea that this economy would have been recession if it hadn't been for tech spending. And that overlay is confusing things, and that is the reason why people are saying the markets and the economy kind of are looking very, very different right now.
I'm so happy you keep bringing up this Deutsche Bank note, because today in the front page of the Financial Times, they're talking about the vacuum, the hole that's being filled with Elon Musk leaving the White House and the likes of Sam Altman and Mark Zuckerberg trying to fill that hole. And an insider said this to the FT, an insider for the Trump administration: if you took AI investment out of the economy, we'd probably be in really, really bad shape. That's what this is, a marriage of convenience.
Futures right now in the S&P, if you're just joining us, down by 0.4%. The opening bout just around the corner. The next hour shaping up as follows. Brent Schutte of Northwestern Mutual as the record run for stocks cools off. Federal Reserve Governor Stephen Miran as he makes his case for more aggressive rate cuts. And Neela Richardson of ADP as we break down the latest jobs data. We begin this hour with stocks stabilizing after pulling back from record highs. Brent Schutte of Northwestern Mutual Life Insurance writing Wall Street might not want to break out the champagne just yet. The labour market continues to do just the opposite. Brent joins us now for more. Brent, welcome to the programme. In just a moment, we'll catch up with Governor Miran. He's very concerned about what's happening or could happen with the labour market. That conversation's happening at the same time. The credit spreads are super tight and the S&P 500 is within 1% of all-time highs. Is that a tension that needs to be reconciled?
Absolutely. So to me, you spent the entire morning talking about the tails. And so for one of the few times in my career, you could convince me that a recession is on the way, something you've talked about. You've seen the labor market weaken. We're expecting 43,000 jobs next month, which is not enough to replace the current new people entering the labor market. At the same time, core inflation is going to run at 2.9%, which makes the reality that it's been between 2.6 and 3.1 for the past 21 months. And so this is where the oddity is. Those tails are larger, yet the market and credit spreads and everything else, the thing in the middle, kind of where everything turns out just right, are still tight. And that's where I think there's quite a bit of a debate about what happens next.
Brent, you've been worried about inflation taking off next, and perhaps that story is still to be wanted to be developed, and that maybe we're moving on a little bit too fast. Brent, do you think that inflation story could constrain the Fed's easing bias?
Absolutely. We've always said the last mile on inflation would be hard after we came down from the supply constraints of COVID. And that's where that 2.9% and not being at their target of 2% since 2021 is a reality. Where do we go from here? Do they cut now and risk that inflation side of the equation? Or do they cut because of the labor market? And that's where I think there's so much uncertainty that's out there. And maybe just to kind of pile on to the economy is not the markets. I think it is. You've had the AI story hold up the economy, and the AI story has held up a very, very narrow rally in the S&P 500 for the last couple of years. It's held up a very narrow rally in that S&P 500 against small caps and mid caps, and that's where I don't think we can continue like this. We need the market to broaden back out because we need the economy to broaden back out, because what happens if all that AI spending slows?
We are seeing it broaden out, though, Brent. When you look at, for example, the other 493 in the S&P 500 and their earning projections, the earning expectations for next year, at a certain point, if the Fed is going to let inflation run hot, isn't that beneficial for stocks on some level?
Yes. And so to me, this is where you have optionality. To me, if you do have a recession, I think rates are going lower. That will help those parts of the economy that have kind of been in a recession-like place for the last couple of years, and that'll help those parts in the market. At the same time, if we do have inflation that runs away because economic growth does revive, I think that helps those parts of the market also. And that's where you look at relative valuations right now in a very expensive market, where you see small and mid cap at relative valuations they haven't seen since 1999, which was an incredibly similar time period where you had the internet and Y2K spending holding up the U.S. economy and also being reflected in a very narrow market. And that's where I think if you look at the next few years, it did broaden back out. The equated S&P 500 did well. Mid caps and small caps did well. And even if you look at the past 25 years, mid caps and small caps have outperformed large caps, even with large caps doing well the past 5-6 years. And that's where I want investors to focus on planting those seeds today that you can harvest later, because I do think valuation matters, especially in an S&P 500 that it's at the second highest CAPE ratio in the last 150, 160 years.
The one fear that a lot of people keep raising is that this is a different moment in terms of the technological sea change that's happening, and how much this could actually could drive a number of smaller and mid-sized companies into obsolescence, especially as large companies have the capital to invest, to create those moats around themselves, and to adopt to some of the changes more quickly. At what point is there a different paradigm for smaller companies that don't have the same agility, that don't have the same balance sheets as larger ones, facing into what is a pretty transformative moment?
This to me reminds me of the narratives that Wall Street makes up at different points in my career. And so I heard a lot of the same things back in 1999, and I actually worked at a bank. And if you recall, there were going to be no bank branches any longer because the internet was going to make those obsolescent. And that's where I think if you look today, there are still bank branches. And so the answer is probably somewhere in between. And that's where I think AI becomes a benefit now, not just to the companies who are implementing it right now and laying the train tracks, but to those who actually use it to increase their margins at a time when margins are being squeezed, which I think it becomes more of a whole society thing pushing forward. And that's why I would encourage people to kind of take those narratives with a bit of a grain of salt, because I've heard all the different ones over the last 100-some years, not me 100 years, but you've had those. And that's where you mentioned the commentary this time is different, and that still makes me scared in just a bit of a way.
Brent, you certainly don't look that old. Don't worry about it. Brent, in about 7 minutes' time, we're going to catch up with Governor Miran of the Federal Reserve. He made a big splash in his first meeting at the Federal Reserve, pushing for a 50 basis point rate reduction. What do you make of his argument? How persuasive do you find it? And Brent, ultimately, what would you like to know in the next few minutes?
Yeah, I mean, to me, this is where I just think the current situation is so odd that you have all these different economists who haven't seen tariffs like this for 90 years, so they don't have much history to go upon, where there's such a broad variety of opinions. That's where I think it's so odd and so interesting of a time period. And that's where I'll bring it back to something from an investing standpoint. There are myriad outcomes that could occur. You could have higher inflation, certainly as something. You could also have a recession. I don't think there's much area in between. And that's where, to me, you come back to diversification and investing in that manner. I think it's interesting to hear his comments on where the neutral rate is, and maybe just to push a little bit harder on that, because he seems to be at quite a bit of a lower level than what most of the other Fed members are.
He certainly has a different view. Brent, thank you, sir. Appreciate it. Brent Schutte there of Northwestern Mutual Life Insurance. Looking forward to that conversation in about 5 minutes' time.
Yeah, how much does he really understand neutral as something closer to 2% and what that actually means for how quickly a raise can get cut? And frankly, I'm just fascinated, but Morgan Stanley is kind of on the same page as he is.
Yeah, not much daylight.
Yeah, it's not as though he's a complete outlier when it comes to rejiggering a concept around neutral.
What happens if he's right? We talked about that last week. What if he is right? What would that mean for this market? Already very close to all-time highs and credit spreads at multi-decade tights.
Yeah, it means basically to the moon, right? I mean, in terms of valuations, the real question that I have is, what does this do for inflation? And why has the economy not completely fallen out of bed if we were this restrictive for this long?
I've got the very same question in front of me too. I think we all have the same one with regards to that. Equity futures right now in the S&P 500, negative by about 1/3%, with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. Former French President Nicolas Sarkozy has been convicted of criminal conspiracy. Paris judges made the ruling over allegations his 2007 winning campaign was covertly funded by the regime of late Libyan leader Muammar Gaddafi. Sarkozy is expected to serve a 5-year jail sentence, even if he appeals. Meanwhile, Disney is preparing for a legal battle with President Trump after it put Jimmy Kimmel back on the air. The Trump administration has threatened to revoke the broadcast licenses of Disney's local stations. Disney's leadership has consulted legal experts and says it is confident it will win any case. And Oracle launched an $18 billion U.S. investment-grade bond sale, the market's second largest deal this year. The debt raise comes as Oracle begins to fulfill massive cloud infrastructure deals with customers like OpenAI and Meta. Sources telling us here at Bloomberg, the tech giant issued the debt in 6 parts, including a rare 40-year bond. That's your Bloomberg brief. John?
Yahara, thank you. Some real demand at that offering yesterday afternoon. Up next on the program, Federal Reserve Governor Stephen Miran as he makes his case for more aggressive rate cuts. That conversation is just around the corner. Live from New York City this morning. Good morning.
equities, we've been modestly underweight. It has been a brutal year to be modestly underweight equities. But this is the deal. This is the issue we're dealing with, is that this market is priced for perfection in a far from perfect world. There are going to be risks into next year. Next year is going to be a tougher year than the markets are pricing in.
That was Matt Miskin of John Hancock on this market. Your market right now just a little bit softer going into the opening bout. Heading into the opening bout, let's turn to the Federal Reserve. The newest Federal Reserve Governor, Stephen Miran, making the case for aggressively lowering interest rates to avoid damaging the economy, diverging from some other FOMC members. I'm pleased to say that joining us this morning, live from the Federal Reserve, is Governor Miran himself. Governor, welcome to the programme, sir. We've got tons of time to talk about what's going to happen next, your thoughts on the labour market, the balance of risk, the broader economy. I actually wanted to lead the conversation with this one. Governor, what was your experience like? I'm sure this was unexpected 12 months ago. What was it like walking into the room, and was it different to what you expected?
Good morning, and thanks for having me. It's great to see you again. Look, walking into the room, I had a good briefing ahead of time about what the meeting would be like, and so that was very helpful. But I will say that everyone was extremely friendly and welcoming and kind and collegial, and I really appreciated that. And it's important to understand that the FOMC is a body, the Federal Open Market Committee is a body that makes decisions by arguing on the merits of the economics and the merits of policy. And that's how it was, and everyone was very collegial in airing their views, and I the same, and that's how it'll continue to be. We make policy, as the chairman said last week, by persuasion, and so I will continue to try to lay out my views and make the case as best as I can.
Governor, I sense you got the opportunity to articulate your argument. Just how much daylight did you sense there was between you and everyone else on the committee?
Well, I mean, it's sort of funny. If you look at the dots in the summary of economic projections, obviously there's a divergence between my projection for appropriate policy for 2025 versus where the weight of everyone else's is. But if you look at next year and the year after, I'm sure I'm still on the low end, but there's not really that much daylight between all the rest of the dots and myself and following year. So it's really just about the speed with which we come down to what's closer to neutral.
Well, let's get into the neutral argument. I think that's what separates you from a lot of people. So you've got it in the mid-twos, Governor, and you think we should get there quickly. Can you just build out why you believe that's the case and why we should get there so fast?
Sure. So, look, I discussed a number of forces which have kicked in over the course of this year and which are, I think, in stark contrast to where they were last year. So I've argued that neutral was higher in the past than it is now, and that neutral was higher for a variety of reasons. But I've highlighted recently fiscal policy, sort of driving up net national borrowing, decreasing net national savings, as well as immigration policy, driving what was the biggest positive population growth shock in my lifetime and has now turned into the biggest negative population growth shock in my lifetime in very rapid succession relative to how changes in population growth normally occur in the data. And so, to me, when you have huge swings in net national savings driven by fiscal policy, and you have huge swings in population growth driven by changes to border policy, it would be bizarre for me to think that wouldn't have implications for the fundamental structure of the economy that gets reflected for monetary policy in the neutral rate. So my view is that neutral was higher last year because of these reasons. And so last year policy was not as tight as a lot of people believed. And now neutral has come down or is in the process of coming down. And now policy is more tight than people believe. And this has happened recently. These policies didn't change, sort of overnight. They've been kicking in over the course of the year. And that means that policy is becoming tighter every day as these policies continue to kick in. And my view is not one of enormous economic pessimism. I don't think the economy is about to crater. I don't think the labor market's about to fall off a cliff. However, the neutral rate is drifting down. And as a result of that, it's incumbent upon policy to adjust in response. And the longer that policy stays excessively restrictive, the greater the risks to the downside for the economy. If policy stays excessively restrictive for too long, then you do get to in a situation in which you have a meaningful increase in the unemployment rate and a failure of the employment mandate.
So, Governor, that's the tension, I think, in your view, that's worth exploring just a little bit more. On the one hand, you don't think the economy's at risk of breaking down, but you also think we are excessively tight at the moment and getting tighter. There are some people who would say, and we've had this conversation around the table this morning, if we were as tight as you're suggesting, why is the market within 1% of record highs? Why are credit spreads super tight? And why is this economy still doing okay?
Yeah, so that's a perfectly natural thing to ask. And let me say two things. One, I don't think that all financial conditions are universally loose like that. In particular, if you look at the housing market, I think it's in quite a different state than sort of some financial markets and sort of security markets. So I don't think that that's necessarily a holistic look at the world of financial conditions in the economy. But even that aside, I think that people in financial markets tend to focus a lot on monetary policy because interest rates are sort of huge tradable instruments, right? But there's so much more that goes into determining economic growth and the state of the economy and inflation and employment than monetary policy. And I think that attributing all changes in financial assets to monetary policy can be a mistake. And in particular, that's what I tried to do in my speech. Was to draw out some of these effects from non-monetary policies that are affecting the economy and, of course, therefore also financial markets. And so if you have changes in tax policy, right? Like significant incentives for investing that lower the effective tax rate on capital, of course that's going to get reflected into capital assets. If you have significant changes to the regulatory environment, where you're removing barriers to operations that companies can make more cheaply, which, by the way, is disinflationary and pushes out the output gap, then, of course, that's also going to be reflected in asset markets. So I think it's a mistake to conflate the state of financial conditions with monetary policy. They're connected, they're related, they affect each other, but they're not exactly the same thing. And in the speech, I go line by line through these different items. And the reason why monetary policy doesn't have to react to the hawkish side in response to these policy changes is because they push out the supply side of the economy at the same time that they push out demand. And so if you're increasing supply and demand at the same time, there's no change to the output gap. And of course, it's monetary policy job at the end of the day to be balancing the output gap, to be balancing aggregate supply and aggregate demand in the economy so it doesn't overheat or underheat.
I think there are a lot of people, Governor Miran, who would agree with you that probably the neutral rate is quite a bit below where we are now. You said even the other Fed governors did seem to agree with that, but not necessarily the speed. And I'm still unclear. Why do you think it is so important to get rates down by 125 or 150 basis points more this year if inflation is still running hot and you're not seeing anything alarming in the underlying economy?
Yeah, so this year is merely a function of where the calendar is. So my view is that policy is quite restrictive, and so I'd like to adjust quickly to get back to a more neutral area, right? That just means a series of 50s until you get much closer to zero. The fact that it's this year is just a function of the calendar. But again, it comes back to the longer that you stay restrictive, the greater the risks. And let me put it this way. Like, it was just a few years ago that we were having endless conversations about declining population growth rates and the whole world becoming Japan in terms of interest rate profiles, right? Those forces are still real. Those dynamics are still real. They didn't go away. Those channels, those channels by which population growth affects neutral rates didn't disappear. I would rather act proactively, right? And sort of, we know that we just had the biggest population growth shocks in many people's lifetimes, mine included, right? We know what the consequences of those are economically. I would rather act proactively and lower rates as a result ahead of time rather than wait for some, giant catastrophe to occur because you suddenly wake up and find out that you are sort of resuming those dynamics. In my mind, if you wait to see the result of that, you will have waited too long, and there will have been a potentially quite material downside miss to the employment mandate.
A lot of people on this show have been wondering what the reaction mechanism is going to be for a Federal Reserve that does start to see inflation as transitory once again. The idea that we have been above 2%, the 2% target for the Federal Reserve for 53 consecutive months for more than 4 years. If there is an upsurge in inflation, how long are you willing to look through that if you are cutting rates before you say, hold on a second, maybe we need to stop?
Yeah, so I would want to understand why there was an upsurge in inflation and what was driving it, and then sort of think about whether that shock is likely to be persistent or whether the shock is likely to be transitory. And it's the nature of the shock. It's not just is inflation higher for a certain number of months, it's why is it higher? or why is it lower? And how long are those shocks likely to persist? And if you have a situation in which inflation is much higher because there's, let's say a very significant expansion in national borrowing that drives up demand, could be driven by fiscal, could be driven by something else, that might be the type of thing that you would expect to be more persistent in my mind. If you have the type of shock that's driven by a, basically one-off change to tax rates, right, whether that's a VAT tax or tariffs or anything else, that in my mind is not the type of shock that would lead you to think that inflation is going to be sticky for a long period of time. And in fact, there's, most central banks around the world, I think actually all of them would sort of, encounter this in a much more direct manner through changes in value-added taxes. And they always look through them. They always say, okay, look, the VAT went up or the VAT went down, and that's going to affect the inflation statistics for a period of time. But then we all know that this was basically a fiscally mandated price change, and monetary policy shouldn't respond necessarily to fiscally mandated price changes because that's not indicative of changes to the underlying supply-demand balance in the economy, which ultimately drives the type of persistent inflation that the central bank cares about.
Governor Miran, I'd love to get your thoughts a little bit more deeper on housing. This is something Matt Miskin, Neil Dutta have talked a lot on this program about. Going into next year, do you think the housing market will weigh on a deceleration of inflation? Is that part of your thesis on inflation coming down?
Yeah, I mean, it explicitly is. I mean, look, supply and demand dominates all things economically, right? And if you're increasing the demand for housing by dramatically increasing population growth without a material increase in the supply of housing at the same time, of course, you are going to get upward pressure on shelter inflation. And then vice versa, if you start decreasing population growth because of a change in border policies without destroying shelter supply, or if shelter supply keeps on expanding at a rate that it has been in previous years, then you get a relative change in shelter inflation once again. So it's simple, it's simple supply and demand. If we have a material downward population shock because we have negative net migration, that's a net increase in the supply of shelter. And I think that the study that I cited in the speech on Monday, work by Albert Sayes, found that an elasticity of 1, basically that a 1% increase in the number of immigrant renters leads to a 1 percentage point change in the rents.
Right, but immigration is
in
short-term,
yeah.
right? This is a short-term story. Would you be willing to revise up neutral if immigration is not much of a drag?
Well, I mean, I have good reason for expecting that the immigration story is going to persist at least for another 3.5 years. And I think quite likely potentially after that also. So I'm not convinced that immigration is really a short-term story.
Governor, just before you go, because I know you've got to run, have you got a taste for this? Is this a position you'd like to keep beyond the end of this year?
Look, I love this country, and I'm happy to serve this country in any way that I'm asked to do so. But personnel decisions are not decisions that I make.
Governor Miran, appreciate your time. Diplomatic end. Thank you, sir. Thank you very much. Governor Miran from the Federal Reserve on the next views from the Fed and his argument for a much lower neutral rate.
Yeah, and the key issue here in terms of how much daylight there is between him and the other Fed members is the speed. And he's saying that recently he saw a real turn, and you might as well get ahead of that, especially with a very different backdrop. Also, really interesting what he said about some of the other inputs to asset pricing and how that doesn't necessarily have to do with Fed rates, kind of agreeing with some of our previous guests talking about how it's been a Fed independent equity market in particular.
The question you ended on is the one I was thinking about the entire time. Is this going to be a Governor Miran just till January, or is he going to be someone that the Trump administration decides we are going to keep him in that spot? And I think this is becoming very political in Washington, obviously, because he's still keeping he has a leave of absence right now from CEA, so 1 foot kind of still in the White House. But if he continues going on this and trying to change the thinking of the Fed, this is really going to be the future. The Treasury Secretary said he wants more of a Greenspan-led Fed, forward-thinking, not data-dependent.
In just a moment, we're going to get jobless claims at about 8:30 Eastern Time. Mike McKee's been tracking a conversation we've been having around the Federal Reserve. Mike, the labour market, if you look at jobless claims, I don't know what the number's about to be in 2 minutes' time, but jobless claims so far look OK, don't they?
They do, and that's part of the story that Jay Powell and the rest of the Fed have been telling, that we're in this unusual situation where we're not hiring people, but we're not firing people either. And the question is, which direction do you go and how fast do you get there? The whole question with Stephen Miran versus the rest of the Open Market Committee is where is neutral? And he makes a big case for negative population growth because of the negative labor force growth because of immigration. And that should start to show up in the jobs numbers, but not necessarily in terms of layoffs. So the jobless claims numbers may not settle that debate.
Mike, how persuasive is his argument at the moment, and how well received is it based on the communication we've had subsequently?
Well, it hasn't been extremely well received because there are some holes in his story, and some of the research he's cited isn't necessarily considered the best research. But the real issue is he's talking about this negative net migration, but the labor force has not slowed, has not fallen. So the impact he's talking about hasn't happened yet, but the inflation impact is still happening. So that's what the rest of the Open Market Committee is looking at this point and saying we should be cautious here.
Mike, stand by. We'll get those results in just a moment. I just want to tee you up with the price action 60 minutes out from the opening bell. Equity futures are negative by about 1/3% on the S&P. On the Nasdaq, we're down by 0.5. In the bond market, bond yields shaping up as follows. Yields higher by about a basis point on a 2-year to 363. With that economic data, with jobless claims and a whole lot more, here's Mike McKee.
Well, John, we are certainly not seeing any problems in the labor force connected to jobless claims. 218,000, a big drop from a revised 232,000 last month. So it doesn't look at this point like we have a firing problem at all. Initial claims, continuing claims, 1,926,000. That's down a little bit from a revised 1,928,000. So all in all, jobless claims numbers still show companies sitting on the sidelines not making decisions. What else have we got today? We've got the advanced good trade balance. It is 85.5, a deficit of 85.5 billion. That's down from 102.8 billion last month. There was a lot of thought that what we were seeing in July was imports pulled forward because the tariffs were going to take effect in August. They did take effect, and it looks like we've had quite a change in import balances there. Durable goods orders up 2.9% after falling 2.7% the prior month in July. The core goods, capital goods orders, non-defense ex-air up 0.6. That was up 1.1%. So it's down a little bit, but not what you would consider any kind of bad news. And finally, we've got the GDP, annualized GDP numbers, their third revision, the second revision, the third issue. 3.8%, a significant revision up from 3.3%. Personal consumption is the reason Americans spent more money, 2.5% from 1.6%. No real change in the GDP quarterly price index is 2.1% for headline on the year over year, and 2.6% for core. Both of those a little bit higher, but that's not the number we're looking at. We'll look tomorrow for the latest monthly release.
And Mike McKee, thank you, sir. I just want to sit on one data point. There are many here, but let's pick out one. 218 on jobless claims. 218. We're freaking out about the labour market. Big downshift in payrolls. I understand the concerns. I'm not dismissing them. You see it. It's real. But the fact that claims have come in at 218, it doesn't speak to any kind of weakness whatsoever.
And even continuing claims actually came in slightly. They didn't expand. So people are coming off that. Look, no one is saying that this labor market is falling into a ditch. The point is, do you need to have a more robust labor market in order to get growth that can sustain a lot of the expectations currently in markets? Do we need things to be a little bit less frozen? And ultimately, that might be the argument. But no one is saying that this is a labor market that is falling off a cliff.
I wish Governor Miran was still with us. Pretty impressive data points there for jobless claims, at least. Yields are up at the front end by, let's call it 4 basis points on twos, 364. There's been a steady grind higher in bond yields ever since the Federal Reserve cut interest rates last Wednesday. The 10-year bond yield higher by about 3 basis points, so approaching again 420. We're at 417. And in the equity market, we were softer going into this print. We're softer still coming out of it. We're down 0.4% on the S&P, down by 0.8 on the small caps. Joining us around the table, Nita Richardson of ADP. Nita, good morning.
Good morning.
That claims number, pretty impressive, hey?
It is. In fact, if I would have just parachuted in from like some other place in time
5%
and
GDP
saw those
growth,
numbers that Mike McKee just read, I would be like, so what's the issue? What's the problem here? This is a perfect economy. But the thing is, I've actually not parachuted in. I've been here the whole time, and I've been looking at the data. And there are some cracks here that I want to uncover because, yes, it is a low hire, low fire. It's been well-established jobs market. It's a stasis that I've been talking about with you for the better part of the year. But if you look, that stasis is having an effect that is not uniform in the labor market when it comes to wages. And wages, as I've said before, are the bridge between the jobs market and inflation. Inflation, when I look at those Fed projections, we're 4 years above target and 2 years to get to target. So wages are going to play a big role. And what you're seeing is that for low wage earners, those are the ones who were keeping wages higher for longer, they are losing ground to high-income workers. So even though we have this low-hire labor market, wages are suffering for those who are most affected by inflation, low-income earners.
So this raises a question about what that means on a bigger scale, whether this tends to be a leading indicator of lower income workers are not seeing the pay raises that can keep up with inflation, whether that kind of leads a broader downshift, or if this just continues to emphasize the K-shaped economy where you have the high income earners benefiting from their wages, benefiting from the market, and benefiting from a world that seems to be increasingly catering to them.
Exactly. So when you look at that GDP print, it was on the backs of a 2.5% consumer spending growth. And that growth we think of as being really top heavy. So when you look at the labor market, and I said this last week with you, that the labor market is supporting consumers, but it's not consumers supporting them uniformly. So for high income workers, you're seeing that their wage growth is actually peaking up from a year ago. Whereas for low income workers, it's decelerating fast. And so the disparity is rising, and that's going to show up in consumer spending trends. You're going to see this disconnect between high-income people and low-income people. And who are those low-income workers? Well, the majority of them are women. 60% of workers at the bottom of the pay distribution are women, compared to 30% at the top end of the distribution. And they are concentrated in certain industries. Those industries happen to be where all the gains have been: health and education, leisure and hospitality. So this disconnect in the labor market is going to show up in a disconnect in consumer spending.
If the Fed were to cut rates aggressively this year on the heels of our conversation with Governor Stephen Miran, do you think that would change the picture? Would you see a pickup in the wages and the employment at the sort of lower end of the income sphere?
It's hard to tell. You might see a pickup in hiring, which would generate some more momentum in wage growth at the bottom end. You may not see a tilt in the housing market, because that is also an inventory affordability story, and most mortgages are priced off of the 10-year, not the short-term rates. So it's hard to tell exactly how Fed policy would move through to Main Street, but it wouldn't be instantaneous. Fed policy is still going to operate with a lag on Main Street, so you wouldn't see the gains. But with 3.8% GDP growth, you probably don't need to see those gains right now, broadly. But to the people who it matters most for, maybe there would be an increase in hiring, which would spill over to wages.
Well, wouldn't have to be a wage increase if, like Governor Miran says, this pace of immigration policy we're seeing in the Trump administration is not short term? He thinks this is going to continue for the remainder of 3.5 years?
Well, let's hold there. There's a lot going on with demographics in the labor market. It's not just immigration policy. It's the fact that 10,000 Americans every day are turning 65 and older and leaving as well. So those shifts are being seen in the labor force participation rate. It's edging down. You have the sandwich generation being impacted in terms of the number of hours they can contribute if they're taking care of their parents and their children. So there's a lot going on demographically. What it ends up being is labor shortages. Those shortages could tilt up wages in the sectors that are most needed to take care of an aging population. But what I read in that is inflation. And that's what you don't want to see. You don't want to see a wage cycle that leads to an inflation increase.
When it comes to the other part of the labor markets, of course, a lot of these grads coming out of school unable to find jobs. How much is AI part of that story, even though there should be enough supply given what's happening in immigration and given this aging workforce?
AI is having an effect on early career. We've partnered with Stanford on research showing just that, using ADP data, that if you are in an AI-exposed field, a software developer, customer service
Isn't that
agent,
everything at this point? AI exposed almost?
No, there are some jobs, a plumber, HVAC. There's actually quite a few jobs that are not AI exposed, but those aren't the jobs that young people, or especially college graduates, sometimes are oriented towards. But if you're in the healthcare field, needed more than ever, and you can see the employment trends going up. So not in 2025. Maybe in 2035, every job will be an AI-exposed job, but not now.
Nita, it's good to see you. Always is. Thank you. Nita Richardson there of ADP following that better-than-expected jobless claims data, the right kind of downside surprise. Kevin Gordon at Charles Schwab writes in, the biggest two-week drop in claims since October 2021.
Yeah, if people were looking for some sort of confirmation of ongoing weakness, well, congratulations, you didn't get it. You actually got quite the opposite, the sense that things aren't falling out of bed. And it just goes to the ultimate question that we've been asking so much on this program, which is, are we heading into a reacceleration? Are we already seeing it, especially ahead of some of the infusion of cash from the One Big Beautiful Bill, and with the likes of the airlines saying that actually they're seeing bookings pick up? So, I mean, it might be on the heels of the upper quintile of earners, but nonetheless, that is the personal spending. That is some of what you're seeing maybe in this data.
If you're long equities, that's what you're priced for into next year. Let's see if we get it. Long equities with a reacceleration plus the interest rate cuts. There will be questions about that if we continue getting data like this in the labour market. 218 for jobless claims. Big downside surprise. The estimate was 233 in our survey. Push that through the bond market and you were getting higher bond yields at the front end of the curve, up by 5. 2's up to 365. 10's up by 4 to about 418. Let's get you an update on news worldwide with your Bloomberg Brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. Let's recap that latest economic data. We saw weekly jobless claims fall by 14,000 last week to 218,000. That's the lowest level since mid-July. Analysts surveyed by Bloomberg were looking for 225,000 to 242,000. And don't bet against the U.S. consumer. Personal spending for the second quarter was revised up to 2.5% from 1.6%. Meanwhile, Best Buy has been making job cuts, including reductions to its Geek Squad team. The changes come as the electronics retailer has been impacted by tariffs and struggled to reignite the level of growth it saw from pandemic-era buying of computers and other gear. Shares of the company are down nearly 14% so far this year as of yesterday's close. And Jimmy Kimmel's return to late-night TV drew 6.3 million viewers, the most ever in the show's regular time slot. The total is significantly higher than the 1.6 million viewers Kimmel has averaged this year. That's according to Nielsen data. The host's opening monologue was also viewed more than 26 million times on YouTube and social media services. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Appreciate it. Up next, we'll catch up with Chris Hyzy of Merrill and Bank of America Private Bank. Plus, Danny has your morning movers. IBM climbing after HSBC says it found a way to use the company's quantum technology. That stock is up by 2.8%.
Policy is quite restrictive, and so I'd like to adjust quickly to get back to a more neutral area, right? That just means a series of 50s until you get much closer to zero. Those channels by which population growth affects neutral rates didn't disappear. I would rather act proactively. If you wait to see the result of that, you'll have waited too long.
Governor Miran making the case for much lower interest rates and getting there quickly. We just had data moments ago. 16 minutes ago, jobless claims 218. Big downside surprise. No problem in this labour market based on that data point. The estimate was 233. The response to it, bond yields higher, equities softer. We're down by 0.5% on the S&P 500. On the Nasdaq, down by 0.7. With that move in the bond market, small caps down 1 full percentage point. Twos at 366. With about 44 minutes away to the opening bell, let's get you some morning movers, some single names. Here's Danny Berger. Hey, Danny.
Hey, John. Intel continues to climb higher, but has lost some of its steam, was up more than 1%. Now just up 0.5% on this report that they approached Apple for an investment. That's maybe the key, that it was just an approach. It's in early stages. The two are talking about how they can work together, but a lot of skepticism, including Bernstein analysts saying that IBM doesn't have a money problem necessarily. It has a capability problem, and money won't help with that. Elsewhere, CarMax shares plummeting this morning. It missed on a variety of metrics. Used car prices fell. Sales fell to about 7%. It is very clear that what CarMax saw in the first half of the year was that pull forward effect from tariffs, and that has started to ebb. So shares there down 14%. Finally, the buzzy story of the morning, and that is HSBC saying, hey, we figured out quantum computing. We are using IBM servers, and we've been able to more accurately predict the price of bonds by 34% in a trial. There's some questions as to how you extend that trial and if you can use it more widely. Even so, IBM shares up 2.5%, John.
What a crazy story. Danny, thank you. Thanks for the update. Big rally for that name this morning, and others too. Let's turn to the Federal Reserve. Chris Hyzy of Merrill and Bank of America Private Bank writing loosening conditions, including further Fed rate cuts, support risk assets further. Chris joins us now for more. Chris, good morning.
Good morning. Thanks
They're
for
on
having
top.
me.
Decent numbers like that.
Yeah.
Labour market data. What do you make of that claims data?
I make of it what I always do, which is week to week is data points are pretty noisy. It doesn't necessarily mean it's a trend, but it is something that I think we'll likely see, which is right around those numbers for the foreseeable future. There's a little bit of a supply and demand balance in the job market overall. Many companies are still in the wait and see mode as it relates to how you democratize artificial intelligence. So claims numbers are pretty much in line with what our belief is, which is a reacceleration coming, not just in real growth, but nominal growth and ultimately profit growth.
Are you seeing any signs of that already? Beyond that jobless claims number, where are you seeing signs of a reacceleration? Where are things firming up?
You know, it comes down to the beginning of the year before the tariffs were put in place. There was this notion that you'd have double-digit profit growth for this year and then next year. Then it was ratcheted back by pretty much everybody across Wall Street. Now we're back to the numbers again where they were at the beginning of the year. So it's a reacceleration. We're seeing it already in profit revisions, not just for third and fourth quarter, but already for 26.
Do CEOs and CFOs believe it? Do they believe it enough to actually take big steps and engage in some of the M&A, engage in some of the hiring plans that they were talking about maybe late last year, early this?
Really depends on the actual sector, obviously. But in terms of the general broader community, you're starting to see sentiment, the soft data, start to change for the better. Remember when we were all talking about soft data being weak and then it was going to filter into the hard data? Never did. Now soft data is coming back. You're seeing in the small business segment a little bit because of rates coming down, but a little bit better economy, perhaps an adjustment to the neutral rate coming down a little bit, as Governor Miran just said. All of that coalesces around better optimism from the corporate side. I would say this, though. Margins have held in there, and that's the key. The bottom line is being used on an efficient basis. Some productivity is increasing. But when you get a little bit above average inflation, that feeds directly to the revenue line. And you don't have to produce as much to get that higher revenue number. So that's why margins have actually stayed in there, in some cases actually widened out.
This sounds like a perfect scenario. It sounds like just nirvana, investing nirvana. It's priced as though it's investing nirvana too, though. At what point have we priced all of that in and then some that leaves it kind of vulnerable to anything that doesn't look like what we just got from jobless claims?
Yeah, Lisa, that's a great point. And I think a lot of that is priced in the here to now. But much of it is still not priced in for next year. There's a little bit of discounting of what the story I just laid out already, given where the S&P is, 22, 23 times forward. I would say that in this asset-light world that has driven the index higher, multiples are higher because they're still driving higher revenue growth. And if you look at the contribution of the tech sector, it's about 44% or so. Of the market cap of the S&P, but its earnings contribution is in the 30s. That's very different than 99 and 2000, when the earnings contribution was almost one half of that peak.
The investors you speak with, are they more worried about some sort of downturn in the economy, or are they more worried about missing out on the next leg higher?
You know, they're still worried about the downside scenario. They still have that frame of mind of the credit crisis, little frame of mind of what happened in August through December of 2018 when the Federal Reserve was raising rates, when inflation was below their target at that point, and then fast forward into 22 with the inverted yield curve and then the tariff situation in April. So they still have all of this in their mind, and they're comfortable still getting a decent yield on their cash. On the flip side, there are some that are very worried about missing the next move, particularly as it relates to the infrastructure build out of artificial intelligence. We believe there's some room to go there. We would caution, though, the signs of artificial intelligence and infrastructure build out peaking are all about the margin, all about the price side of the equation. We're not seeing that yet, But we need to watch that closely to understand what the demand for that will be once all of this is built in.
Clients that are concerned about the downside, is it because they think we're in a bubble?
They always talk about bubbles. Number one question I get right now is, are we in a bubble?
Are we?
I had 4 different meetings yesterday. Number one question. In some cases, in areas that are low quality, that don't have any revenues, that are built to sky-high valuations, you can argue yes. In other areas where they're still kicking off very good free cash flow, the answer is no.
So what's your advice?
The advice is diversified portfolio. I know that sounds like, okay, that's easy.
You're killing us, Chris.
Right? I know.
What's the
We talked
second
about
question
this
investors are asking?
But diversification works when you need it the most, and you can still participate. So for us, it's about having a little bit more non-U.S. than you would traditionally have. We heard before about potential weaker dollar. Weaker dollar is probably a fading dollar story, not necessarily a weaker dollar story, given where growth is for us relative to the rest of the world and their deficits relative to ours. Small caps benefiting from a little bit of lower rates on the short end and potentially a reaccelerating economy. Mid caps for whatever M&A cycle is around the corner. And then on the large cap side, I think it's 2 stories. It's the rest that we always talk about that are starting to rotate a little bit. A little bit on the value side. Those areas that were starved for capital, like materials and energy and others. We're still overweight financials. We're still overweight industrials, consumer discretionary, and utilities. We're trying to make sure that we stay balanced where we can, but participate in the AI growth story.
Does balance mean a little bit of gold as well?
Well, it's fortunate. We don't actually have it in our asset allocation schema overall, but yes, gold is showing some incredibly different signs than it normally would. It has a negative correlation with treasuries right now, which a lot of people aren't talking about.
And a positive correlation with risk assets for the year so far.
That's right. And also defensive assets. It's throwing off signs. Again, it's not perfect, but when you get one of the largest central banks in the world recycling their own foreign reserves and Euro reserves are not going up, but gold is. That's an interesting story.
What do you think's behind all that? Is there a dominant driver or just multiple pillars?
I think it's this regional economic trade zone developments from this ultra-competitive global world we were in for so long. As the world looked to the U.S. to fund their growth, now with all of that switching, I think you're going to have to see some of these central banks diversify their reserve base.
Bramo nodding along. Agrees with you entirely.
Well, if you look back to when it really started, it was 2022 with the Ukraine and Russia conflict, when Russia invaded Ukraine. This question of repatriating some of the money, and that really kickstarted a central bank diversification away from the dollar. And that, I think, people have just seen accelerate from there.
Frozen Russian assets are a big piece of this conversation.
Absolutely. The Russians realized, their central bank realized they could just freeze our foreign holdings, so we need to diversify. And then other dictators around the world, like the Chinese, were also like, wow, we should probably actually up our gold as well.
Chris, it's good to see you. Thanks for dropping by. Thank you, sir. Chris Hyzy of Merrill Bank of America Private Bank. Gold, what a year so far. Equities too, by the way, both equities and gold. Our guest from Deutsche Bank earlier on this morning saying a lot of people just liked what? It was the S&P, it was gold and EM. The S&P, gold and EM.
Yeah, I just am imagining someone walking through Midtown just totally draped in gold saying, I'm diversifying, I mean, at a certain point.
Security.
I just think it's really an interesting moment right now as people rejigger their ideas of the macro trade landscape and what it means to be diversified.
We've got to wrap up and rejigger our views on this labour market. That number, 25 minutes ago, what a jobless claims print. 218, that's a really strong figure.
I'm struggling to get my head around what these numbers mean. Exactly, because if we're looking at low hiring, then if you have that level of firing and you don't have that many new people brought in, what kind of stagnant market are we looking at? This is a very confusing economy. I don't know that it's going to get that much clearer.
218,000, the estimate was 233. The bond market doesn't like it. Yields are up at the front end by 6 basis points. Equities a bit softer on the S&P 500. Session lows, we're down by 0.5%. Coming up tomorrow, Cameron Dawson of New Edge, Mike Dada of Roth Capital, Victoria Fernandez of Crossmark, and the former Fed president, Jim Bullard from New York City. This was Bloomberg Surveillance.